In this talk, you learn how the basic accounts payable function works. I've put together a comprehensive look at the process and have arranged the topics in what I believe is a very logical and progressive order. The goal here is to give you a good foundation in a few short hours, or if you've been away from the function for a bit, a good review. So let's start at the very core of the accounts payable function. Chapter 1, Basic Invoice Processing. So let's get started. Well, we said that it doesn't matter how the invoices arrive. You can do a lot to ensure that this step goes smoothly. Let's take a look at some best practices you can use in that regard.
And let's start off with what address you use. What address are you going to give your vendors to send your invoices to? Well, in today's world, you want to have 3 addresses. You want to have a postal address that is very precise. You don't want the vendors sending their invoices to your headquarters address, for example. So your address for where they send the invoices to should be something like ABC Company, 124 Main Street, second floor, or attention accounts payable, or maybe even it would be a post office box. Maybe you're going to receive the invoices there. You should also have an email address where your vendors can send their invoices, and that should also be very specific. It should not be an individual's email account. So it should be invoices at ABC Company, accounts payable at ABC Company, whatever works for you. You also might want to have a fax, although a fax number, although faxes are on the decline, if you will, as far as being a business tool. But you might want to have a specific fax number that your vendors can use if they want to fax it to you. And ideally, you'll have that fax facility hooked up to an e-fax facility so that paper fax gets converted into an electronic document.
Now, this may sound easy. You send it out for approval and then move right on. But sadly, like most other tasks in accounts payable, it doesn't always work the way you'd like. Sometimes approvers are busy. Work with me, please. I'm trying to be nice here. And they don't approve invoices in a timely manner, or they don't get to the approvals. What can you do about it? Glad you asked. We've got some tips that will help. Let's take a quick look at the 3-way match.
What is the 3-way match? This is the process every accounts payable department should use to ensure that invoices that they are paying are accurate, legitimate, and have not been already paid. As you know, duplicate payment of invoices can be a problem, and it's an even bigger problem now because we have so many suppliers who are sending duplicate copies of invoices. But I digress. Back to the 3-way match. Okay, the 3-way match involves 3 documents: the purchase order, the receiving document, and the invoice. So when the invoice shows up in accounts payable, the accounts payable department then looks in the system for the purchasing order that goes along with it, and hopefully the invoice had the purchase order number on it, so that will make that a little bit easier, and the receiving document. They should match all 3 of them, and when they all 3 match, they set it up for payment. Now, in most organizations, before the 3-way match is done, that invoice is sent to purchasing for approval, or to whoever who placed the order for approval. You would think that that person would do the checking and make sure that it matched what was on the purchase order, but that rarely happens, or it doesn't happen that often, and that's why the accounts payable department does the 3-way match. Okay, so you've got your 3 documents, you've got your approval, and hopefully if everything matches, you can then set it up for payment and the vendor can be paid and everybody will be happy.
Let's look at some of the best practices surrounding the 3-way match.
Best practice number 1. And I realize that if you're in accounting or accounts payable, this might fall outside your purview, but it's something to really keep in mind. You want to make sure right off the bat, from the beginning, that you get off on the right foot. This means that the purchase orders must be accurate every single time. An accurate purchase order means one that's filled out completely, and also one that the purchaser did not mindlessly check off standard terms and conditions before sending it. Many payments being made today with checks could be made with either cards or ACH. Do you agree? Is your organization trying to reduce the number of paper checks? Let us know in the comments below. Cards are the perfect payment tool to handle small dollar invoices, which may be clogging up your accounts payable. Used with the proper control, you can eliminate a large number of invoices and then have your AP team spend their valuable processing time on larger dollar invoices. There have been many new card product introductions in recent years, so you might want to take a look at them. When reviewing all the advantages of card programs, keep in mind your supplier's needs as well. While many are happy and even prefer to take cards for, let's say, a $100 transaction, you may find their joy fading quickly if you try and get them to take it for a $100,000 invoice, even with a reduced fee. ACH payments have been growing in popularity as many recognize the drawbacks of paying with a paper check. ACH payments are electronic payments, but they are not instantaneous. It is important that you realize that. They have been used successfully for years now for direct deposit of payroll and direct deposit of Social Security. In growing numbers, companies are now using them to pay their suppliers. In fact, in the US, ACH payments in the B2B world now exceed 50% of the payments made. While we celebrate crossing this threshold, the rest of the world looks at us incredulously, as most make almost 100% of their payments electronically. I've had non US people tell me things like, I don't even know where my checkbook is. And when COVID hit, our management said, no more paper checks. ACH can be used in place of many wire transfers as they are quite a bit less expensive and in place of paper checks, as we've already discussed. As you may have guessed, not only has there been a lot of innovation in the payment world, there's a lot more coming in the next few months and years.
I would be remiss if at this point I did not point out the danger of making duplicate payments. Saying you never make a duplicate payment is like saying you never make a mistake. Now, you may think that this is no big deal since surely suppliers would return the duplicate payment. Sadly, only a few do. So here are a few tips you can use to avoid that nightmare.
I want to start off by smashing that myth that vendors will return duplicate payments. Here's the secret: most of them don't. Now, a few will issue credits, and then there's issues with credits as to whether your people find them, they take them, etc. But many of them don't. They quietly put the money in their pockets and never say a word about them. And then there are a few who pull this little nasty trick that happened at one company where I worked. The vendor got the duplicate payment and came in to see the chief operating officer. I don't remember exactly for what, but whatever. And he brought that check, that second check that we had sent, and he threw it on the office's desk. And he said to him, glad to see you doing so well. Glad to see you can afford to pay us twice. Okay, as you can imagine, what happened after the guy left was not pretty. Everyone has three opportunities to prevent, detect, and recover duplicate payments. But you've got to take action to do these. So let's start. I call it the before, the during, and the after. That's my way of breaking these things down. So let's start off with the before. What can you do before you get that invoice and you process it? Well, it's some very simple stuff, okay? You want to incorporate best practices, make sure you have strong internal controls in your processes for handling invoices and making payments. And those processes should include strong internal controls and not limited to, but including separation of duties. You also want to minimize or eliminate as many weak practices as you can. Let me give you an idea about some of those weak practices. Returning checks to the person who placed the order, the requisitioner, as I like to call them. Petty cash boxes. All of these are opportunities, if you will, for a duplicate payment. Let's talk about during. What can you do during the processing of an invoice to ensure that you don't pay it twice, or at least help minimize the chances of not paying it twice? So I want to share with you a little story. I was at a conference, this was a few years ago, and I was talking to a guy who was an AP director of a huge company. And the reason I make such a big deal about it was a huge company, because when you see the numbers that I'm going to talk about, you're going to say, what? That wasn't an issue for them? And he shared with me that they just had a duplicate payment audit done. And his company, the last time they'd had an audit done, which I think was 2 years prior, the audit firm found $2 million. This current audit, they found $57,000. So 2 million might not be a lot of money to a $1 billion company. And if 2 million wasn't a lot, 57,000 was really not much. So I was all ears, if you will. And I said, "Oh, what did you do?" And he said, "Oh, all that stuff you talk about." And what he meant was using things like rigid coding standards, making sure that when invoices are processed, that the standards that are used are rigid and you've spelled it out and you've given it to your processors so they all know exactly how you want the data entered. I like to say when it comes to data entry and accounts payable, creativity is not desired, not a desirable function, if you will. Limiting the payment types for each vendor also will help. So then you don't have to worry. You made one payment with a check, let's say, and another one with a credit card. You also don't want to allow the payment of invoices either on expense reports or through the petty cash box. Some companies will take it one step further. And when they have what they consider a large payment, and of course, what is large is going to depend upon your individual company. Obviously, a large payment at Apple is different than a large payment at the corner stationery store. So, whatever's large, you want to double check those items to make sure that they've not already been paid. I also like to tell people that they should, if they've got rush checks or items that were paid off a check request form because the invoice was lost, that they might want to put them in a folder and then go back and research 2, 3 weeks later, a month later, to make sure that that invoice did not show up and get paid. Also, you probably want to have some special processes and procedures in place for payments that are made through wire transfers, because that's a whole nother issue. And also, if you are having payments made outside AP, you want to have some processes in place to make sure that those folks are using the same strong practices and controls that you use in accounts payable. We see at a number of companies, companies will have ACH payments made outside AP, maybe in treasury, maybe elsewhere in accounting. I want to say that that happens at about 20% of the companies. And as more companies are increasing the number of ACH payments, there's also a possibility of increasing that. Now, we're going to talk about after the payment's made, because there are some things you can do that. But first, I want to say a big thank you to all our listeners who very thoughtfully give us thumbs up or likes on our recordings. And if you have any other tips on preventing duplicate payments that I haven't shared, feel free to put them in the comment field, or of course, I always like to hear from people. Okay, after the payment's made, the money's out the door, but it doesn't have to be out the door forever if you paid twice, which hopefully you didn't. But at a minimum, you want to audit your payments. When I say at a minimum, I hope everybody who's listening today is doing statement audits. And that's where you call your vendors and you ask them to send a statement showing all outstanding activity, all open activity, not just open invoices. They're happy to tell you about the open invoices, but you want to find out, are there any open credits that we don't know about? You want to get that money back, obviously. So if you haven't been doing that, that's kind of a no-brainer. And if you do find a credit on a statement that was due to a duplicate payment, you want to investigate, because you know what they say about where there's smoke, there's fire. Or, and as I like to say, where there's a duplicate payment once, it might happen more than once. And so you want to investigate what happened, figure out, was there a weakness in your controls and your processes, and then fix it. Okay, you want to close that loophole, whatever it may be. Also, you want to be very careful about those vendors who change the invoice number, and many of them do. Some of them will just add like an A to the end of the invoice number for the first copy that they sent out and a B for the second copy, but others are change the invoice number completely. So you want to be very careful about those vendors, and when you figure out who they are, you want to make a special notice of them so that you can always check to make sure that you don't have them. Okay, so be very careful about them. And again, when you find a duplicate, you want to analyze what was wrong, what went wrong in our system so that we made this payment. Now, some of you, hopefully not you, but a few people out there might be sitting there thinking, saying, well, we don't make duplicate payments. Our system won't allow it, or whatever reason that you have. Let me just say this. Maybe you don't make duplicate payments often, but saying you never make a duplicate payment is like saying you never make a mistake. I like to say, from my lips to God's ears, everybody does occasionally. And by the way, if it's only occasionally and your staff makes one, take it into consideration that this is something that happens everywhere. Now, if you still think, hey, she's making a big deal about nothing, let me just point out one more issue to you. A lot of times, fraud in general starts off with an honest mistake. So you pay someone twice, they realize they got that second payment, they don't return it, God forbid, and then they say, aha, maybe if we send invoices twice, they'll pay twice, and they start doing it. So, an honest mistake can sometimes lead to fraud, so which is why you want to stay on top of this issue.
These discounts are really important to the organizations that are offering them, so it is critical you understand what they are and how they work.
Early payment discounts are exactly what they claim to be, a discount for paying early. Let's take a look at the nitty-gritty of how early payment discounts work. For starters, not every supplier offers them. Typically, they are negotiated during the initial stages of the business relationship. They should always be included in the terms and conditions. Some suppliers offer them as a matter of course, and others don't offer them at all. This is one of those situations of if you don't ask, you don't get. So ask. All they can say is no. For the purposes of this talk, we're going to focus on the most common discount offered. The discount does not have to be these numbers, but just I want to make the example and I want to make sure that you understand it. So it's 210 net 30. It is typically written the number 2, a slash sign, the number 10 net, the number 30. This means that a full payment is due on the 30th day after the invoice date. However, if the invoice is paid within 10 days of the invoice date, the customer can take a 2% discount, hence the 2/10. So if you had an invoice of $100, the customer has a choice of either paying $100 on the 30th day or $98 if he pays it in day 1 through 10, up to the 10th day. The $98 payment is arrived at by taking 2% of 100, which is $2, and subtracting it from the total amount of $100. Any payment after the 10th day up until the 30th day should be the full $100. There are no partial discounts in the early payment discount world. You'll sometimes see the term early payment discount or early pay discount abbreviated as EPD. Now, you may be looking at this simple example and wondering, why would anybody make a big deal about this? She's talking about $2. So the answer is twofold. First of all, the smaller dollar amounts add up. And secondly, for most organizations, early payment discounts represent the best financial alternative they have. The 210 net 30 converts to a 36% rate of return. For most organizations, unless you're out there collecting money with a baseball bat, which I'm thinking you're not if you're listening to this is probably the highest rate of return your company can get with absolutely no risk. I'll skip the math for now, but perhaps we'll do another broadcast showing it. So if you're interested, let us know in the comments below. So as many companies would like to get more early payment discounts, your suppliers are not such a big fan of it, okay? So it's up to you to ferret out these opportunities. Here are 3 quick ways to do that. So number 1, pretty simple. Make sure you earn all the early payment discounts you're entitled to. This means identifying those vendors who offer early payment discounts and then fast tracking the processing for those so that you're able to get them paid within the 10th date. For many organizations, it is difficult to get an invoice processed, approved, and scheduled for payment in such a short time. But that's what you need to do. You need to also stay on top of your approvers because that's often where the holdup is, and make sure they understand that approving quickly is important in this case. Okay, that's tip number 1. Tip number 2. Many times, offering an early payment discount will be a standard within a particular industry. So if you have a vendor that is offering you an early payment discount, look at all the other vendors in the same industry that you are doing business with, and then approach them and ask them if they offer early payment discounts. Some will, some won't. Again, they don't like it, so they're not going to volunteer the information, but if you approach them, they may relent. Tip number 3, you want to train your processes to look at invoices closely. And if it's on one invoice that you get where you normally don't get it, know that this vendor is properly offering it to others. So ask. So if you're doing business with vendor, XYZ, and they don't offer you early payment discounts and you typically don't get one, and one of your processes knows that one invoice comes through and it's showing an early payment discount, this means that they might be offering it to some of their other customers. And so you want to ask, see if you can get to be one of them. Again, if you don't ask, you won't get.
Discrepancies when they're doing the three-way match. They need to be resolved and they need to be resolved quickly. Let's take a brief but deep dive into how you can do that.
What do you do with the data related to the accounts payable process three-way matches that go wrong? i.e., when you match the invoice against the purchase order and the receiving document and they don't match. There's a wealth of business intelligence in that data if you choose to collect and analyze it. And I'm sure you're going to realize that I'm going to recommend that you do that. It can and should be used to drive process improvements across your entire procure to pay chain, not just the accounts payable function. And let's talk about tracking discrepant invoices. You absolutely should be tracking them. You can do it in your ERP system if you have the functionality to do that, but many ERP systems don't have the functionality. And so someone, usually the accounts payable manager, does it in a separate spreadsheet. You can just do it in a simple Excel spreadsheet. And you want to do this for a number of reasons. Obviously, you want to get the invoices discrepancies resolved, but you also want to do it in a timely manner. Because if you don't do it in a timely manner and the due date passes, the vendor will send a second invoice. So you'll have one copy of the invoice, and then you'll get another copy of the invoice. And if it still is not resolved by, let's say, 60 days, if payment was due at 30 days, you'll get still another copy of the invoice. And maybe you'll get more than them. So a lot of extra work, a lot of extra invoices, and occasionally some of those invoices get paid twice, those second and third copies, and we absolutely don't want to do it. So here's how you can do it. Let's assume that the accounts payable manager, the director of accounts payable, maybe an assistant controller is going to do it. And what you're going to do is you're going to take a spreadsheet and you're going to keep track of the discrepant invoices and who's supposed to resolve them. Now, I'm not going to start ranting and raving about the fact that most of the time the responsibility for resolving discrepant invoices lies in accounts payable, when accounts payable is the group or the person who has the least amount of information, be that as it may, but it's usually in accounts payable. And you're going to create this spreadsheet and you're going to have columns across the top and you're going to try and capture every possible piece of information. So you'll have the invoice, the date that you got it, who was the purchaser, who was the supplier, who was the AP person, and any other relevant people who were associated with this. Then you're going to put common reasons why the match might fail. Let's say inaccurate invoice, pricing error. There's a million other reasons. You know what they are. And a lot of them will be peculiar to your organization. You're also going to date this. You're going to date when the invoice came in, when the problem was identified, when the emails were sent out either to purchasing or to your supplier to try and get it resolved. And you're going to keep track of this. You can use this for two reasons. Number one, for tracking purposes, to make sure that you get these discrepancies resolved in a decent amount of time quickly, so you don't get those second invoices that I talked about. And also for analytical purposes, so that you can try and use them as I'm about to describe. You're going to have a comment field also in this, and you are also going to put dates down when the problem was identified, how long it took different people to respond, and when it was resolved. Okay? And you want to make sure your invoices don't languish, and you also want to collect this data. Now, periodically, and what I mean by periodically will depend upon your organization. If you only have one or two discrepant invoices, let's say a month, well, this is going to work for you. But I suspect if you're like 99.75% of the people who I encounter, this is not the case. So periodically, it could be weekly, it could be monthly, it could be quarterly, depending upon what your workflow is, what other work you're doing, and the nature of your business. You're going to pull the spreadsheet out and you're going to review it and you're going to sort the data and try and identify common problems. So, for example, you might sort the data and review by reason for the discrepancy, which, by the way, you're going to enter onto the spreadsheet afterwards when the item is resolved. So a little extra work maybe in keeping the spreadsheet up. Maybe then you'll discover that one of your processes in AP has an inordinate amount of the problems. Or perhaps you're having poor purchase orders come out of a particular unit in purchasing, whatever. You're going to review this data. So now you've identified the problem and you need to take action. Now, I would strongly suggest that you start with any problems that may be in AP so that when people start pointing fingers and saying, well, did you look in your own house? You have some data to back it up and say, yes, we did, and we fixed our problems. So if the problem is in accounts payable, is it with one person, one group? You want to talk to that person, maybe even if it's just like one particular processor and maybe their manager, and see what's the problem. Do we need more training? Maybe that person was new and didn't get adequate training. Maybe you had an automation solution and the training that you was given was, good for 6 of the people on your staff, but this one person didn't understand something. Or maybe they're sloppy and they just need to take more care. But be very careful about assuming, that somebody is sloppy. Maybe getting 2 screens for your processes. Maybe that would help. I was on a call this morning where I heard people are talking about getting 3 screens and a few people even getting 4 screens. So you can see where we're going with that. Okay. So that's, once you've narrowed down your AP issue. Now, let's say the problem was inaccurate purchase orders. Let's say that's what you discovered was the problem. Maybe in this place, the supplier is notifying purchasing of pricing errors, and rather than issuing a corrected purchase order, the purchasing person figures, accounts payable will catch it. Well, that's not acceptable. That creates more work for AP, and it also increases the chances that maybe something will slip through and you'll pay more than you should. So maybe there's one area in purchasing, maybe one location is making all the mistakes. And in that case, maybe there was more training that's needed. So there are many different reasons. Once you identify the reason, then you can talk very tactfully, I might add, to the group involved and try and get that fixed so that the errors related to that particular cause are, I want to say eliminated, but from my lips to God's ears. Okay. Now, if the problem is with the invoices, you need to tread very carefully because you don't want to offend the supplier, especially if it's a large supplier. And this might be something that you might have to work with purchasing and maybe approach them together. And it could be, honestly, that you'll talk to them and nothing changes. And, you can't make them do something. I mean, maybe you cannot do business with them, but I doubt that the organization is going to decide not to do business with them because accounts payable isn't happy with the invoices that they sent. Just a sad fact of life.
Chapter 2, the ever important early payment discounts.
Early payment discounts are the holy grail of the finance and accounting and accounts payable world. They are so important that one accounts payable manager explained to me one time that the only mortal sin in the eyes of her boss was missing an early payment discount. So let's take a simple example. Let's look at a $100 invoice that is dated June 1. Payment terms are 2/10 net 30, and that's written 2/10 net 30. Let's go through and look at what each of these numbers means. The 30 means that the payment for the invoice is due in 30 days. Okay, so a June 1st invoice due on June 30th. The 10 means that if you pay it before the 10th date, you are entitled to a discount. So if you pay it before June 10th, you're entitled to a discount. And the 2 is the discount. It's a 2% this discount. So in this example, it means you are entitled to a 2% discount if you pay on or before the 10th day. So let's do the math. 2% of $100 is $2. So if you pay on the 10th day, i.e. June 10th or earlier, you can pay $98. That's a $100 total minus the $2 discount. So only $98 if you pay on or before June 10th. Any payment after that date will require a full payment of $100. Now, you may be looking at this and thinking, is she for real? Why would anybody make such a big fuss over $2? So what's the fuss? What's the big deal? Okay, $2? These discounts add up, and they especially add up on larger invoices, and they add up quickly. So in the example that we just did, the 210 net 30, be aware that that discount equates to, if you did all the math, a 36% rate of return. Today, there are basically no legal investments where you can be guaranteed a rate of return of that magnitude. That's why savvy finance and accounts professionals always look for ways to earn more early payment discounts.
Chapter 3, more than just invoices, the 17 different types of documents used in accounts payable today. Invoices and purchase orders are just the beginning of the documents you need to recognize and understand in order to work in, manage, or have responsibility for the accounts payable function. I'd love to be able to provide you with a sample of each of these as we talk through them so you would know exactly what to look for. Sadly, each company has their own format, and for most of these, so understanding what they are is critical in order for you to understand what to do with each of them, because you're not going to be able to recognize them visually, or at least in most cases you won't be able to. Okay, let's start off with document type number 1. No surprise here, invoices. Very simply put, an invoice is a bill for goods or services that have already been delivered. Typically, it can be billed in advance, but usually you're billed after the fact. It is issued by the seller and sent to the buyer, and it can be sent either electronically or by mail requesting payment. And you all, know this as bills, like you get your credit card bill or your electricity bill, etc. Companies get those types of bills, but they also get bills for goods that they order. You and I, when we order stuff, like when we order from Amazon, for example, we pay in advance, but companies will get the good, for the most part, we'll get the goods, and then we'll have negotiated payment terms, and we'll pay for them at some point afterwards. All right, document type number 2, it's the purchase order. This is when a company places an order with another company. They send a purchase order so the seller knows exactly what they want ordered, how many of them, and any other special terms that may be agreed upon. And these are typically today sent electronically. Typically also the purchase order will reflect any special terms and conditions, and it will also reflect the payment terms. Next document type, the third type I want to talk about, are receiving documents. Sometimes these are called packing slips, and these are documents provided by the seller to the buyer, and they itemize or describe the materials, the service, or the work product being provided under the order or in the container or the box, if you will. If you've ever ordered goods, you've probably seen them. And for example, when you order from Amazon, typically you'll get a small piece of paper that's put in the box. It's about 3 inches by 3 inches, unless you ordered a lot of stuff, but usually it's just that little tiny piece of paper, and it will document what you ordered, and it should match exactly what's in the box. And in fact, if you're receiving doc, the folks on it work or do a good job, they will verify that what's on the receiving document is actually what's in the box. Okay, next type, receiving reports. These are summaries typically used by companies, and they record the materials received from suppliers during deliveries. Typically, again, these are prepared. This report is prepared by the receiving by the receiving staff, and is shared with the accounts payable department to notify them of received goods. And then this receiving report can be used instead of the receiving documents, if you will, when doing the three-way match, in order to verify that not only only is everything on the invoice correct as far as the amount, the goods, the price, etc., but also that you actually did receive them. Hey guys, I just realized I did not introduce myself. I'm Mary Schaefer, founder of this channel and the AP Now podcast, which now has over 600 episodes. I've also written over 20 business books, most focusing on accounts payable issues, but enough about me. You didn't come to hear me talk about myself. So the next document type number 5, if you will, I'd like to talk about our credit memos. These are typically issued by sellers when there is a reason why they owe money back to the purchaser. So it might be because you got a discount because a few different branches ordered the same type of widgets and you were entitled to a quantity discount. That's the good news. It might be because you made a duplicate payment. It might be because you had a discussion with them and they overcharged you, or something was broken and you want a refund, whatever. They issue this credit memo, and the goal with the idea with the credit memo is they send it to you and then you use it as a credit on a future payment. So if the credit memo was $10 and you had an invoice for $100, then you put that you use that credit memo to pay that invoice, and you'd only pay $90. Related to that are debit memos, which is sometimes called debit memorandums. These are documents issued by the purchaser requesting a refund if a payment has been made, or a credit memo, as discussed just recently. Not every organization uses them, but if they do, this is what they are, and you need to be able to recognize them, and also recognize the difference between a debit memo and a credit memo, because you don't want to get credit twice. Okay, moving on to document type number 7. This is the advanced shipping notice. It's a document that provides detailed information about a pending delivery, and the purpose of these advanced shipping notices, which by the way you'll see abbreviated as ASN, is to notify a customer that when shipping has occurred and provide them with physical characteristics about the shipment so the customer can be ready to accept delivery. And as you might expect, these typically are associated with large items, very common in the automotive industry, for example. If you ever hear a discussion about a 4-way match used in accounts payable, the advanced shipping notice is typically the 4th document that they are talking about. Okay, the next document type that I want to talk about, document type number 8, I'm trying to get 8 fingers up, okay, is the billing notice. Now, a billing notice is technically not an invoice, and you are typically not required to pay it. The best example that I can give you a bit of legitimate billing notices are those renewal forms that you get for subscriptions, maybe to magazines, to newspapers, to whatever, and they'll come, and you'll notice that they look a lot like an invoice. And I'm not saying that the sender is trying to trick you into paying it, but it should say renewal notice on it. Now, going back to invoices, you may have, when you start looking at a lot of invoices, you'll notice that many of them will have in big letters at the top the word invoice, because they want you to recognize it as an invoice and know that you have to pay it. Renewal notice, clearly that it's not the same thing, and in fact this is sometimes renewal notices by themselves are legitimate, but some criminal enterprises have kind of skirting the issue and graying the waters or muddying the waters will send renewal notices that look an awful lot like invoices. They won't say invoice on them, but sometimes in very tiny letters on the bottom it will say something like this is a renewal notice, this is a billing notice, you're not required to pay, but very small letters. Legitimate companies, magazine companies sending renewal notices, perfectly fine as long as they make it clear that that's what it is and there's no obligation to pay. Of course they're hoping that you'll think it's an invoice and automatically pay it, but okay, enough about that. Just no legal obligation to pay a billing notice or a renewal notice unless you decide you want to renew, and then absolutely pay it. Okay, document type number 9, if you will. I call that this is the W9, and this is the one standard form. If you're watching on YouTube, you can see we'll have flashed up a copy of it. It's an IRS form that requests the payee, or actually anyone for that matter, to provide a correct taxpayer identification number, referred to as a TIN, T-I-N, taxpayer identification number, to the person who is required to file an information return with the IRS. And the information returns, which I'm going to talk about in a minute, are those infamous 1099. Most companies have one on hand that is filled out and scanned so that they can email it upon request. Most accounts payable departments have a blank one on hand and will automatically send it to new suppliers or suppliers who have changed some sort of their basic information. Typically, this is used with what's referred to as U.S. person, i.e. someone who has some sort of a U.S. taxpayer identification number. You should always be using the most recent W-9, and if you don't have it or you're not sure if you have it, go to irs.gov and you can download it. Now I want to talk about its sister, the W-8. Okay, for starters, there are several different W-8s, including the W-8 Ben, B-E-N, the W-8 Ben E, the W-8 ECI, the W8EXP, and the W8IMY, to name a few. These are forms that are used by non-U.S. persons, and they can be quite complicated. I'm not going to lie to you. In fact, one of them is 8 pages long. If you need to request these, you need special instructions on this entire matter, and this, in all likelihood, will be provided by someone who is an expert in these matters. These are used by non-U.S. persons, okay? Okay, the information on the W-9 is used for our next document type 11, the Form 1099. Now, there are many different types of 1099s, but the two most frequently used in the accounts payable space are the 1099 MISC and the 1099 NEC. Business payers will use the Form 1099 MISC to report certain types of miscellaneous compensation such as rent, prizes, awards, healthcare payments, and payments to an attorney, and they report these to the IRS and to the recipients of these payments. So each 1099 in effect gets issued twice. Recipients are then required to report those payments as income on their tax returns. Part of why everybody gets so crazed about them, just part of it. Okay, the next document type that I want to talk about is B notices, or backup withholding notices, which come in the form of a CP 2100 or a CP 2100A notice. This is a notice from the IRS that tells you you need to start backup withholding unless a named TIN match is rectified. Okay? The IRS explains it this way. A CP 2100 or a CP 2100A notice to taxpayers, which can be a financial institution, business, or person, who files certain information returns with incorrect taxpayer identification numbers to begin backup withholding. There's a lot that goes into the proper handling of these notices. You need a tax reporting expert to help you with that. So I just want you to know what they are so that hopefully you'll recognize them. CP 2100, CP 2100A. Okay, our next document, type number 13, is what I call a check request form, although we are moving fast into an era where we might call this a payment request form. Now, typically, if you work in accounts payable, you get an invoice and you pay it. But sometimes there is no invoice, the invoice gets lost, somebody needs a special payment, whatever. There's a whole bunch of reasons. And so most companies have what's called a check request form or a payment request form. And what this does is it tells you who the payee is. It tells you if you mail a check where it's going to be mailed to. It should have some backup. It should tell you what this is for, and then it should be signed by whoever's making the request, and it should be approved or authorized by someone else, someone who has the authority to do this. You want to minimize the number of these if you can, you possibly can, because they are more apt to be associated with a duplicate payment, or even worse, a fraud, because of the lack of documentation that surrounds it. Could talk for a while about them, and if you want me to do a more in-depth talk on check request forms or payment request forms, just put a comment in the put a note in the comment field, and we'll take that under advisement, if you will. Okay, next payment type is a remittance advice, and in the paper world, when we issue paper checks, that is the stub, if you will, the check stub, and it breaks out what the remittance is for, and people like this because it helps the recipient of the funds do their necessary cash application, especially if you're paying more than one invoice with one check request with one check, or if you've taken some deductions and you can spell it out what the deductions were for. Document type number 15, vendor statements. Now these are statements sent by the vendor vendor and ideally showing all open activity. Some vendors will automatically send them. Sometimes you'll have to ask for them. When you ask for the statements, make sure that you let them know that you want them to show all open activity, not just your outstanding invoices, which some of them will do. And your goal when you get these vendor statements is, first of all, to recognize their vendor statements and not pay them. Sometimes they look a lot like an invoice and people are mistaken. But, to look through them and see, for example, if there are any open credits that you didn't know about. And if that's the case, then you want to take them. So it's generally a recommended best practice that you get one vendor statement from each vendor at least once a year, and then vendors that you have more activity with or that you tend to end up with more vendor credits, then you request those more frequently. That's vendor statement. Similar to vendor statements, document type number 16 are bank statements, and these are exactly the same type of statement that you get on your own bank account. It's a statement. They usually come monthly. They almost always come monthly, and they show all activity for the month. So they'll start with the opening balance, show all the money coming in, all the money going out, whether it's a wire transfer, an ACH, or whatever, and then you'll have an ending balance. And those bank statements are typically reconciled on a very timely basis, because if there is any activity on there that you don't recognize, you need to investigate and try and get any funds back immediately if they were not authorized. Document type number 17 and the accounts payable aging report. These reports summarize a business outstanding bills and invoices by vendor and due date. This helps companies manage their cash flow, and these also become more important or less important depending upon what's going on in the organization. But the times when they tend to become more important is at the end of a fiscal period and in times of financial uncertainty. Now, as you've probably noted by now, it's easy to get some of these documents mixed up, which can result in paying something that shouldn't be paid or vice versa. Chapter 4. A deep understanding of the three-way match. As a knowledgeable accounting and finance professional, you know that the three-way match is kind of the holy grail when it comes to accuracy and avoiding payment errors in processing invoices for payment. That's why we're taking a deep dive today into everything related to this important bedrock of the accounts payable function. Let's start with a look at exactly what the three-way match is. The three-way match is used in most organizations who want to make sure that the invoice that they pay is accurate. Once it's got the approval from whoever ordered the item, it comes back and you don't just automatically pay it. You need to make sure the invoice is accurate. That's because the approver rarely checks the details on the invoice, only that they've ordered the stuff. The three-way match matches the invoice with the receiving document with the purchase order.
We're going to go through the process now, focusing on the documents and the common places that errors are made. So let's start off with the purchase order, which, as you know, is the document that starts the transaction. It is a commercial document issued by the buyer, placing an order with the seller. It indicates what is being ordered, the amounts, and agreed upon prices and other terms and conditions. These are often negotiated in advance and will typically cover multiple purchase orders unless it's a special, which we'll talk more about in a little bit. Once accepted, the transaction is set in motion. Now, a little tip, if you will, make sure that the purchase order is filled out completely. This is typically not a big deal in the days of electronic purchase orders. Okay. So what's the big purchase order mistake? You need to remember, if your purchasing folks make a special deal, that they adjust the purchase order. They don't just tick that standard terms and conditions. Sometimes, if it is not about the price, it might be, let's say, about the payment terms that are not reflected on the purchase order unless somebody makes a special effort to change the standard terms and conditions. Oftentimes, when this happens, the purchasing team does not make a note of it on the purchase order and just hopes or trusts that the supplier will make note of it of the longer payment terms when they issue the invoice. But guess what? They often forget. And when this happens, there is absolutely no way that accounts payable can know about the extended payment terms, because purchasing didn't tell them. It's not on the invoice. It's not on the purchase order. So there's no way that they know, and they end up paying using the standard payment terms, and this savings that purchasing worked so hard to negotiate goes up in spurts. Special alert. Anyone who arranges a special deal at the end of the fiscal year needs to be especially aware of this, because this is typically when this happens, although it's not the only time, and it is often overlooked. This is especially prevalent in the pharmaceutical industry in one case. And when I tell you that it is often overlooked, I will tell you that in some instances, companies have overlooked 100% of those savings. Okay, I'm going to stop carrying on about that, and I'm going to move on to talking about receiving documents. Receiving documents are sometimes called packing slips, and typically they're included in the shipment and delineates all the items included in the shipment. You get this when you order yourself. So, for example, if you order from Amazon, you get that little slip of paper and it tells you what's in there. All it says is what's included. It's nothing about price, terms, and conditions. Now, the receiving document mistake, if you will. First of all, the receiving document needs to be verified and verified closely when the goods are received. Oftentimes it is not. The goods are just simply signed for, and it is assumed that the shipment is correct and matches what's on the packing slip. So if the packing slip says 100 widgets, you need somebody to verify that there are 100 widgets. If the packing slip says blue widgets, you need somebody to make sure that they're all blue widgets. Are they damaged? If so, how and where should be noted. You get the idea. But too often what happens is the goods are marked and in at the receiving docks, and no one does this in-depth check at that point. And if no one checks closely, then there is no way to catch a short payment or a short shipment or a defective shipment later on. Let's turn our attention now to invoices, which, by the way, is the document that most believe cause most of the problems with the three-way match. The invoice, or the bill, if you will, is the document sent by the seller to the buyer, basically requesting payment. If it doesn't match what's on the purchase order and what was received, i.e., what was on the packing slip or receiving document, it is considered a discrepant invoice and must be reconciled. Okay. And this happens often. And so it is very important that you don't take the approach, we get an invoice, we pay an invoice, what's the big deal? The problem begins when this reconciliation is not done in a timely manner, and the invoice isn't paid on time, and then the supplier, and they're totally 100% right to do this, sends a second invoice when the payment date passes, and they're looking for payment. And this often compounds the problems associated with it. So now let's talk about some invoice problems, and there are many. So we're only going to talk about a few because you don't want to hear me go on and on all day here. So we're going to just talk about a few of the bigger ones that you need to be on guard for. Okay, invoice mistake number one. Not making sure your suppliers know where to send invoices, making it that they just put a general address on, the invoice floats around, and of course, you get it late and then you can't get it paid on time. You would be surprised just how often this happens. So you want to make sure your suppliers know exactly where to send the invoice, be it a mailing address or an email address, and you want them to do it precisely. Invoice mistake number two, not reconciling these discrepant invoices in a timely manner. I know it's much easier to put the invoice aside that are discrepant and go back and start processing ones that do match, and then I'll deal with these discrepancies later. But you know how that happens. It gets put aside and then it doesn't get worked on for a day, 2 days, a week, 2 weeks, and then before you know it, it's past due. So reconcile your discrepant invoices in a timely manner. And now for the big issue that can be solved by simply talking to your suppliers, okay? Talk to them, and a lot of this problem will go away. Not all of it, but a lot of it. Actively encourage your vendors to send only one copy of the invoice. For when they send multiple copies of the invoice, your chance of making a duplicate payment increases, and you just have to waste time processing that invoice, figuring out it's a duplicate, and weeding it out. So encourage all your vendors to send only one copy of the invoice. And this might even mean picking up the phone and calling them. Now, some of them will have a practice of sending multiple copies and you're not going to be able to stop them.
But just understanding what the documents are is just the first step. You want to make sure you are using all relevant best practices. You can't afford to miss even one. Let's investigate the most important ones related to the three-way match.
Now, best practice number 1. And I realize that if you're in accounting or accounts payable, this might fall outside your purview, but it's something to really keep in mind. You want to make sure right off the bat, from the beginning, that you get off on the right foot. This means that the purchase orders must be accurate every single time. An accurate purchase order means one that's filled out completely, and also one that the purchaser did not mindlessly check off standard terms and conditions before sending it. If the purchaser has made some special arrangement, if it's for something as simple as extended payment terms, that needs to be reflected on the purchase order. For if it's not, and if the vendor forgets about it and doesn't include it on the invoice, there's no way the accounts payable team is going to know it when they pay the invoice, and that wonderful negotiation that your purchasing department did is going to go up in smoke because the purchase order is going to match the invoice and they're going to go ahead and pay. So that's best practice number 1. Best practice number 2, and again, this might be outside the purview of accounting or accounts payable, but you want to make sure the receiving practice, the receiving doc, does what they're supposed to do. This means not just marking off goods in when they're delivered and marking them received, but actually verifying what's in and, more importantly, what's not in the shipment. This may involve checking the quantity, the quality, etc. And any discrepancies should be noted. If you ordered 100 widgets and you only got 95, then you want to make a note that only 95 widgets were received. So when the invoice shows up for 100 widgets, your accounts payable staff can make the appropriate adjustment. Okay, best practice number 3, of course, perform the three-way match before paying every single invoice. Anytime there is a discrepancies, investigate it and resolve it before you pay the invoice. For many, okay, not necessarily everybody, but many, it is becoming a best practice to use technology to automate and streamline your accounts payable invoice processing, your invoice handling process, okay? If you have a large enough volume, and that volume is the number has been decreasing, then this might be a good approach for you. So something to consider, and we've got a whole ton of videos about if you're purchasing a new automation solution and things to look for, etc. Practice number 5, implement strong internal controls. Sometimes people think, oh, well, we're doing the three-way match, we don't have to worry about internal controls. That's not true. You must integrate internal controls, strong internal controls along every aspect of your three-way match, and do it with every single time.
Using best practices is a really good first step. Avoiding common worst practices is also required if you're demonstrating your accounts payable expertise. Here are a few that are commonly used and you should avoid at all costs. Worst practice number 1, not doing the three-way match at all. If you take the approach, you get an invoice, you pay an invoice, and you just operate your accounts payable function like that, you're going to end up paying invoices 2 and 3 times. And trust me, there are a few suppliers out there who, when they realize this is what's going on, they'll send you many copies of the same invoice. Not only that, oftentimes you'll pay an amount that is more than you actually owe. So if you're watching this, you probably are not doing that, but I just wanted to include it because unfortunately there are some companies out there that's how they approach this. Worst practice number 2, when you get an invoice that is for a lower amount than the purchase order, and you think, oh goody, we'll save a few bucks here, and you just pay the lower amount. No, it's a worst practice. And the reason for this is that for the most part, your suppliers aren't stupid, and there's a reason that it's a lower price. Maybe they shipped a lower quality good. Maybe they didn't ship as many items as you ordered. There's some problem here, and you need to investigate what it is, because otherwise there can be a problem elsewhere in your operations. First practice number 3, when purchase orders are missing information, assuming you know what should be in there, because you've seen so many purchase orders like this before. No, you need to go back to purchasing and you need to get them to put in the missing information, because sometimes what you assume will not be correct, and then you'll end up with either a problem later on or paying the wrong amount once again. Worst practice number 4, not having a process to periodically review stale dated open receivers and open purchase orders to determine if they are still valid, and if they're not, closing them out. You need to have a rigorous process in place to do this, because otherwise, if you just leave them out there, they can be used to facilitate fraud. And if you leave open receivers out there, you can end up with an unclaimed estate, unclaimed property auditor claiming that it was unclaimed property, or again, it can facilitate fraud. Now, often there is a dispute within an organization of who should do this, and we can talk about that a lot. But the important issue is that A, it's done, and it's done with the proper controls in place. That you have two-party sign-off, because you don't want anybody playing games there. Worst practice number 5, not having the appropriate internal controls throughout your entire three-way matching process. This can hurt more than many people realize.
You're probably aware that by their very nature, best practices encompass strong internal controls. But do you have all the necessary controls in place around your three-way match? Let's do a quick review to make sure you've got all the bases covered. Three-way match internal control number 1. You need to have rigid coding standards which tell your invoice processes exactly how the data should be entered. This way, there can be no creativity, no misunderstandings, and no invoices getting entered twice. Because this way, if an invoice comes in today and you enter it, and 2 weeks later, another copy of the same invoice comes in and I go in to enter it, it'll be pretty easy for me to identify it as a duplicate. So that's three-way match internal control number 1. Three-way match internal control number 2 is an important one, and this is to make sure you immediately, and underline immediately, extinguish purchase orders and receiving documents after you do your three-way match and it's been successful. You want to make sure that those purchase orders and receivers don't get used a second time. They don't want to hang around so somebody else can process an invoice against them. Now, some folks will wait till the end of the week or the end of the month to close out the purchase orders and the receiving documents. Don't do it. You want to do it immediately, because if you don't do it immediately, and in the interim between today, when you did your three-way match, and the end of the week or the end of the month, another copy of that shows up, it can end up getting processed and worse, paid. So that should be part of your immediate processes. Okay, three-way match internal control number 3. You want to periodically review outstanding receivers and purchase orders to determine their status and to remove them if they're not viable. Now, what is an old outstanding receiver or purchase order will vary from company to company. For some companies or some organizations, it'll be one that's been out there for 1 month, for others 3 months. It just depends upon the nature of your business. But periodically, someone should go through and review these old purchase orders and receivers that have not been matched and determine if they are still valid. Maybe they should have been closed out, but they weren't, or maybe that order was canceled, or maybe there's some other error, but it needs to be done. Now, frequently when this issue comes up, I'm asked, well, for example, with the purchase orders, should purchasing do it or should accounts payable do it? The answer is whoever has the most knowledge should do it, but most importantly, it should be done, okay? Not worrying about who is going to do it. And this falls by the wayside. I can't tell you how often. Three-way match internal control number 4. Periodically, you want to verify that your processes are using the procedures that you have set up for them for processing invoices, and they should be doing it exactly as you have it documented in your policy and procedures manual. This doesn't have to be anything formal, but what you want to do is just, sit down with them. Don't tell them you're coming. Just sit down and watch them process, maybe for half an hour, and make sure that they're doing things exactly how you have laid out. What you want to make sure is that they have not introduced any shortcuts that might be a shortcut for them, but introduces a control weakness elsewhere in your process or makes more work for somebody else. Often this is what will happen. People come up with a shortcut. And by the way, if it's a good shortcut, then everybody should be using it, not just that one person. And you don't want to do everybody in one day so everybody knows that the manager's coming to review. Just go and sit with people, at odd times, but make sure within a 6-month or a year time frame that you sit with everybody on staff. And after a while, and you probably know this without even doing this, you'll know who is likely to have created shortcuts and who isn't. But periodically, you want to make sure you review this. Three-way match control. It's a little bit long, but I want to explain it. Have a process in place that handles the timely resolution of three-way match failures. That's right. When we talk about doing the three-way match, matching the invoice with the purchase order against the receiving document, that's fine. We have it in our processes, but oftentimes people don't have what's going to happen when there is no match. Now, there are two parts of this tip. Number one, you need to have a resolution process. And then the second part, which we sometimes forget about, is this resolution needs to be done in a timely manner. If it's not done in a timely manner, you're apt to get another invoice because the vendor didn't get paid and they're looking for their money. So they'll send another invoice. Best case scenario, you catch it, you don't pay it. Worst case scenario, you don't catch it and you do pay it. And even if you do catch it, it takes extra work and extra resources that most of our accounts payable teams today don't have. They don't have extra people just sitting around to do this extra work. Okay. So timely resolution.
Now, you may occasionally hear other professionals talking about a two-way match and a four-way match. If you understand the three-way match, they shouldn't be difficult to comprehend, but let's just take a moment to go over them. So the two-way match typically involves matching the invoice with the receiving document. This is used in cases where a purchase order wasn't issued and the goods have come in and now you're going to review the invoice for payment. The four-way match is at the other end of the spectrum, and it takes the documents used in the three-way match, purchase order, receiving document, and invoice, and matches them also against what's known as an advanced shipping notice, an ASN, that is usually sent out before the goods are shipped. This is typically used when big orders are involved and a lot of expensive machinery. Sadly, there are exceptions when the three-way match fails. Let me explain.
What do you do with the data related to the accounts payable process three-way matches that go wrong, i.e., when you match the invoice against the purchase order and the receiving document and they don't match? There's a wealth of business intelligence in that data if you choose to collect and analyze it. And I'm sure you're going to realize that I'm going to recommend that you do that. It can and should be used to drive process improvements across your entire procure-to-pay chain, not just the accounts payable function. We'll show you why you should analyze the data and a rather simple way to do it. And let's talk about tracking discrepant invoices. You absolutely should be tracking them. You can do it in your ERP system if you have the functionality to do that, but many ERP systems don't have the functionality, and so someone, usually the accounts payable manager, does it in a separate spreadsheet. You can just do it in a simple Excel spreadsheet. And you want to do this for a number of reasons. Obviously, you want to get the invoices discrepancies resolved, but you also want to do it in a timely manner, because if you don't do it in a timely manner and the due date passes, the vendor will send a second invoice. So you'll have one copy of the invoice, and then you'll get another copy of the invoice. And if it still is not resolved by, let's say, 60 days, if payment was due at 30 days, you'll get still another copy of the invoice. And maybe you'll get more than them. So a lot of extra work, a lot of extra invoices, and occasionally some of those invoices get paid twice, those second and third copies, and we absolutely don't want to do it. So here's how you can do it. Let's assume that the accounts payable manager, the director of accounts payable, maybe an assistant controller is going to do it. And what you're going to do is you're going to take a spreadsheet and you're going to keep track of the discrepant invoices and who's supposed to resolve them. Now, I'm not going to start ranting and raving about the fact that most of the time the responsibility for resolving discrepant invoices lies in accounts payable, when accounts payable is the group or the person who has the least amount of information, be that as it may. But it's usually in accounts payable. And you're going to create this spreadsheet and you're going to have columns across the top and you're going to try and capture every possible piece of information. So you'll have the invoice, the date that you got it, who was the purchaser, who was the supplier, who was the AP person, and any other relevant people who were associated with this. Then you're going to put common reasons why the match might fail. Let's say inaccurate invoice, pricing error. There's a million other reasons. You know what they are. And a lot of them will be peculiar to your organization. You're also going to date this. You're going to date when the invoice came in, when the problem was identified, when the emails were sent out either to purchasing or to your supplier to try and get it resolved. And you're going to keep track of this. You can use this for two reasons. Number one, for tracking purposes, to make sure that you get these discrepancies resolved in a decent amount of time quickly, so you don't get those second invoices that I talked about, and also for analytical purposes so that you can try and use them as I'm about to describe. You're going to have a comment field also in this, and you are also going to put dates down when the problem was identified, how long it took different people to respond, and when it was resolved. Okay? And you want to make sure your invoices don't languish, and you also want to collect this data. Now, periodically, and what I mean by periodically will depend upon your organization. If you only have one or two discrepant invoices, let's say a month, well, this is going to work for you. But I suspect if you're like 99.75% of the people who I encounter, this is not the case. So periodically, it could be weekly, it could be monthly, it could be quarterly, depending upon what your workflow is, what other work you're doing, and the nature of your business. You're going to pull the spreadsheet out and you're going to review it and you're going to sort the data and try and identify common problems. So, for example, you might sort the data and review by reason for the discrepancy, which, by the way, you're going to enter onto the spreadsheet afterwards when the item is resolved. So a little extra work maybe in keeping the spreadsheet up. Maybe then you'll discover that one of your processes in AP has an inordinate amount of the problems. Or perhaps you're having poor purchase orders come out of a particular unit in purchasing, whatever. You're going to review this data. Now, before we get to how you can use this data, if you like this episode, please give us a thumbs up. And if you loved it, please give us a thumbs up and subscribe. Your thumbs up and comments really help us, as YouTube takes that as a signal to distribute this content to more viewers, because if you're happy, they think maybe somebody else will be happy of it. Okay, so now you've identified the problem and you need to take action. Now, I would strongly suggest that you start with any problems that may be in AP, so that when people start pointing fingers and saying, well, did you look in your own house? You have some data to back it up and say, yes, we did, and we fixed our problems. So if the problem is in accounts payable, is it with one person, one group? You want to talk to that person, maybe even if it's just like one particular processor and maybe their manager, and see what's the problem. Do we need more training? Maybe that person was new and didn't get adequate training. Maybe you had an automation solution and the training that you was given was, good for 6 of the people on your staff, but this one person didn't understand something. Or maybe they're sloppy and they just need to take more care. But be very careful about assuming, that somebody is sloppy. Maybe getting 2 screens for your processes. Maybe that would help. I was on a call this morning where I heard people are talking about getting 3 screens and a few people even getting 4 screens. So you can see where we're going with that. Okay, so that's, once you've narrowed down your AP issue. Now, let's say the problem was inaccurate purchase orders. Let's say that's what you discovered was the problem. Maybe in this case, the supplier is notifying purchasing of pricing errors, and rather than issuing a corrected purchase order, the purchasing person figures, accounts payable will catch it. Well, that's not acceptable. That creates more work for AP, and it also increases the chances that maybe something will slip through and you'll pay more than you should. So maybe there's one area in purchasing, maybe one location is making all the mistake. And in that case, maybe there was more training that's needed. So there are many different reasons. Once you identify the reason, then you can talk very tactfully, I might add, to the group involved and try and get that fixed so that the errors related to that particular cause are, I want to say eliminated, but from my lips to God's ears. If the problem is with the invoices, you need to tread very carefully because you don't want to offend the supplier, especially if it's a large supplier. And this might be something that you might have to work with purchasing and maybe approach them together. And it could be, honestly, that you'll talk to them and nothing changes. And, you can't make them do something. I mean, maybe you cannot do business with them, but I doubt that the organization is going to decide not to do business with them because accounts payable isn't happy with the invoices that they send. Just a sad fact of life. So keep in mind that even after you talk to them, you may not be able to fix the problem. And if you can't, okay, this doesn't mean, just give up. Just make a note of who that vendor is. You won't have a lot of them. There'll only be a few that will fall into this category. And then once you know who they are, you always double and triple check their invoices. Yes, it's extra work, but you don't want to pay them twice. Clearly, that's an unacceptable outcome. You've probably heard the saying, a good invoice gets a good payment. Well, how can you tell if you have a good invoice? The answer to that is simple. Complete the three-way match. This very basic accounts payable invoice verification routine can save your organization tons of money. How? By ensuring you pay what you have agreed to pay for the goods both ordered and received at the right time, not too early, not too late. What's not to like about that? We're going to review some of the true power of the three-way match here, the problems and expenses the three-way match helps you avoid. And there are more than you might imagine. The three-way match helps organizations and companies 1. Identify fraudulent invoices so they can make sure they are never paid. No one likes to be tricked into paying for something they didn't order. The beauty of the three-way match is it helps quickly identify those scammy invoices that are attempting to steal from your company. Way number 2. It helps you identify and weed out duplicate invoices, assuming the duplicate invoice number checking routine didn't work, which it often doesn't. As those who work in accounts payable are painfully aware, duplicate invoices has become a huge problem for virtually every company and organization. My informal polling at a number of events leads me to believe that the number of duplicate invoices is somewhere between 20 and 25% of all invoices sent. And, as you are probably aware, most duplicate payments, like 99% of them, are not returned. A credit memo may be issued, but the emphasis is on the word may, and it may or may not make its way to the customer. I'm going to stop ranting and raving about this now, but suffice it to say that duplicate invoices are real and a costly issue. Way number 3, avoid paying the wrong price, which is almost always higher than you agreed to. The purchase order, if filled out correctly and completely, should provide the clarity around this issue to help the staff doing the three-way match know what price was expected. This is just one reason so many folks like the three-way match. Way number 4. Avoid paying for an entire order when only a partial order was received. This is why it is so important that the receiving staff actually check that what was delivered matches what is on the packing slip that was in the order, also known as the receiving documents. For if they just mark the documents received without checking, the organization will have no way of knowing if the company or organization was shortchanged. This is one reason some organizations are adamant about not taking partial shipments. It makes the accounting and payment function difficult and can lead to errors, costly errors. Better to issue 2 separate purchase orders. Way number 5. Avoid paying extra fees that are supposed to be paid for by the seller. This can include shipping or freight, special customization fees. Again, the purchase order will provide you some clarity on this issue. Way number 6. Know when early payment discounts are available and adjust processing and payment timing to take advantage of these very lucrative discounts. The purchase order should indicate if an early payment discount is available. If the purchase order doesn't, then the company is relying on the seller to make a note of that on the invoice. And that may or may not happen. If it's not on the purchase order and the seller neglects to include it on the invoice, there's a good chance the discount will be lost forever. Unless you have a really alert accounts payable person who, when processing the invoice, remembers that the seller involved offers early payment discounts. But really, it's not fair to expect the accounts payable person to remember when the purchasing staff neglected to include this very basic but important piece of information on the purchase order. Way number 7 that the three-way match helps. Take advantage of special deals, especially when special payment terms were arranged. Pay at the right time. 4. If special payment terms were arranged, as they often are at year end, as long as they are reflected on the purchase order, you will be able to avoid paying earlier than was arranged. Think this isn't a real problem? Listen to this very short clip from a longer tip we did on special deals that are frequently lost. And my real life proof, if you will. One large, well-respected pharmaceutical company stumbled across this issue. When they went back and researched their activity, they discovered they had lost 100% of these special deals that had been negotiated with a number of different suppliers. It's important that you understand this wasn't only a one supplier issue, it was across the industry. They went back and they looked for several years, and they discovered each December they took advantage of a number of different special payment terms offered by different suppliers, and none had been reflected on their purchase order, and consequently none were on the invoice. They end up paying for all this extra inventory using their standard payment terms, losing all those special deals negotiated by their purchasing staff.
Understanding the three-way match is a really good first step in implementing a best practice accounts payable or procure-to-pay function. Understanding the entire invoicing processing function and nuances is equally important. Chapter 5, Vendor File Management, now more important than ever. Effectively managing the master vendor file is a critical part of the accounting or accounts payable process. Requires controls, best practices, as well as fraud prevention protocols. It should not be an afterthought, as unfortunately it's some. Let's make sure we're all on the same page and start by defining what is the master vendor file. The master vendor file is the repository of information needed to pay vendors or suppliers. Each supplier should be in the master vendor file once and only once. But that is easier said than done unless very rigid, strict best practices are used around the master vendor file function. To those not familiar with this issue, this might seem like not a big deal, but it is. Some of them will say, what's the big deal? What can go wrong if the supplier is listed a second time in the master vendor file? First, let me state the obvious. When a supplier gets into the master vendor file a second time, it is a sign that internal controls are not nearly as strong as they should be. That second entry shows a breakdown of controls someplace. This is a problem because it makes it easier for the processor to mistakenly pay a vendor a second time, and as many of those who are involved in the accounts payable and payment function know, duplicate payments are rarely returned voluntarily. That's bad enough, but a duplicate vendor in the master vendor file also facilitates fraud, something not many think about. Less than honorable employees trying to play games by submitting phony invoices, for example, know they need to have a vendor file for it to go again. If there's an inactive or duplicate entry that can provide them the cover they need, then they're good to go. There's an even more heartbreaking issue. If you have a duplicate entry in the master vendor file and unintentionally double pay a less than honorable supplier, that supplier may realize you have control issues and amp up their efforts to get you to double pay again. They may do this by submitting copies of invoices to several individuals in your organization, creating tons of extra work for your accounts payable staff, even if they don't eventually double pay. Or they may resubmit invoices that have already been paid. Whatever they do, it's not good. It's extra work for you. They either trick you into paying twice or create a whole lot of extra work for your staff. And as I said, neither of those are a good thing. Not everyone refers to the master vendor file as the master vendor file. What are some of the other names used for the master vendor file? Some refer to it as the vendor master file, and others simply call it the vendor file. Now, in some companies, different departments will have their own vendor files to address whatever their own particular needs are. In fact, sometimes even purchasing will have its own vendor file separate from the one used in accounts payable, but that is not too common. This brings up the next issues related to master vendor file. who has responsibility for the master vendor file. Now, let me be clear. There is no absolute right or wrong answer to this question. The first consideration, and most important, relates to appropriate separation of duties. The responsibility should lie with the group that has enough personnel to handle the function appropriately while still maintaining appropriate separation of duties. As technology takes over more and more of the transactional work in the accounts payable function, the accounts payable departments, like many others, are getting smaller and smaller. So while accounts payable might seem like the logical place to house responsibility for the accounts payable function, smaller staffs sometimes make that impossible for the appropriate separation of duties issues. Once you've addressed the appropriate separation of duty issue, the next issue is who has the bandwidth to handle the day-to-day tasks related to the master vendor file on a very current basis. You can't leave new vendors set up until the end of the month and set them all up at one time then. While this may seem like an ideal situation for the person who has to set the vendors up, it's not ideal for the operation of the business. Since an invoice can't be processed until the vendor is set up, you need to put this responsibility with someone who will set up new vendors and make changes to existing vendors every day or every second day. Now, the temptation is to let invoice processors set up new vendors and make changes to existing vendors, but this creates a control issue as it negates appropriate separation of duties. So as tempting as it may be, don't do it. Another tempting issue is to leave all suppliers in the master vendor file forever, in case you want to do business with them again in the future, and then you won't have to set them up again. The problems with this are several. After a number of years, the master vendor file will be large, unwieldy, and rife with opportunities for error and worse. So let's address the lifespan of a supplier in the master vendor file. Does a supplier stay in the master vendor file forever? Technically, the answer to that is yes, but they should be deactivated if you haven't done business with them in the last 12 or 14 months. Leaving an inactive vendor in the master vendor file, just like a duplicate vendor, can facilitate fraud if you have an employee looking to play games, and by this I mean looking to defraud the company, usually, although not always, through embezzlement. This is called cleansing the master vendor file. The vendor history should not be deleted. This way, if the supplier comes back 2 years from now and claims you didn't pay a particular invoice, and yes, that happens, you have the records to research and prove that you did. Basically, a supplier should stay active in the master vendor file as long as you continue to do business with that supplier on a regular basis. Once you stop doing business, the supplier can be deactivated, but you will always have the history of that relationship. Really important. If you start doing business with that supplier again, you should re-verify their information as if they were a brand new supplier. This brings up the issue of setting up vendors in the master vendor file. What's involved with setting up a new vendor? It first involves entering data provided by the new supplier. Often this information is taken directly from the invoice. And while there is nothing inherently wrong with this approach, assuming you are verifying that it's a legitimate vendor, more on that a little bit later, there are better ways. Ideally, you'll have a vendor form or application, and will also send the new supplier a W-9 from which you'll collect taxpayer identification number and an ACH payment form to collect bank account data so you can pay them electronically using the ACH. This can either be sent by the person responsible for the master vendor file or by the purchasing professional, ideally before they send the first purchase order. However, in reality, most accounts payable departments don't find out about a new vendor until that first invoice arrives. And then they have to hustle to get the vendor information collected and given to the person responsible for the master vendor file. You should also do some basic verifications before making that first payment. Now, before we get to those verifications, if you're getting value from this talk, I would love it if you'd hit the like or the thumbs up button. It sends a message that you are getting value from this talk and I should make more like it. Personal thanks from me to everyone who has hit that button. What basic verifications should you do on the master vendor file data when setting up a new vendor? Once the data is collected, the information on the W-9 needs to be run through IRS TIN matching program to verify if the name and the TIN match what the IRS has on its records. This will greatly reduce the number of B notices you receive, which, if you've ever had to deal with them, you know is a huge pain in the you-know-what and wastes a lot of valuable time. If there is a mismatch, get the information corrected from the supplier and run it through IRS TIN matching again. Do this until it's correct. You want to do this before you make the first payment. The reason for this is simple. As long as the supplier is waiting for their money, they are more likely to comply with your requests. Once you make the payment, the power dynamic shifts, especially if there are new orders forthcoming. At that point, doing what you ask becomes a very low priority for your supplier. It is strongly recommended that this TIN matching be done when the supplier is first set up. Some organizations wait until the end of the year and then run either all their suppliers or all new suppliers through IRS TIN matching. Then they try and correct any mismatches. It's much harder to do at that point for the reasons discussed above, plus some of your original contacts may have left their positions, and tracking down their replacements and getting them to correct the old information will be a real trick of diplomacy. Companies should also verify that their suppliers are not on the most current SDN, specially designated nationals list with the U.S. Treasury, something that was not considered a best practice until recently. The U.S. Treasury's list of specially designated nationals is a list of folks the U.S. government does not want its citizens, or what it calls U.S. persons, includes U.S. companies and other organizations doing business in the U.S., doing business with. It includes terrorists from the OFAC list, as well as drug dealers and others, and you may not pay them. You may recall when Russia invaded the Ukraine, several Russian entities were added to this list. A word of caution. Expect to get some false positive, so no heart failure when running your new supplier through the list and you get a hit. Investigate. In all likelihood, you will find an entity with a similar name or one located in a different country. The last verification that you should do up front involves running the addresses of your new supplier against the addresses in your HR file. The purpose of this is to identify any employee trying to set up a phantom vendor. You won't find many, but when you find one, you will have saved your organization lots of money and headache. It really is very simple to do. But as with other matches, investigate before accusing. There could be a good reason for the match. If you reach the conclusion that there is some game playing going on, get your boss and someone from HR involved before you make accusations. From this, you should take away that your investigation should not involve asking the suspected culprit about the match. This brings up the issue of verification for changes of data in existing suppliers' information. What verifications, if any, should be done when there is a change of information request made for an existing supplier? It's real simple. Any change should be verified. As you can probably guess, this has only become a necessity in the last few years. This has gotten critically important with the explosion of those emails impersonating the CFO or other high-level executive requesting a rush wire transfer, as well as emails from existing suppliers requesting a change of bank account for an ACH. Most are legitimate, but whether you're an accounting manager who has just been told you're now managing the accounts payable function, or a seasoned pro who has been working in or managing the function for a while, there are a number of operational problems that do not get the headlines or attention they deserve. This leaves management and those new to the space wondering why their accounts payable function isn't more efficient than it is. By knowing what these issues are, and everyone, and I mean everyone, has them, you'll be able to do a better job. While this talk was originally designed for accounting managers getting ready to take over the management of the accounts payable function, experienced pros will also benefit from a thorough understanding of what these issues are. So let's start off by discussing the special operational accounts payable issues. Accounts payable operational issue number one. the duplicate invoice issue. About 25% of all invoices received today in accounts payable are duplicates. The supplier has either mailed and emailed the invoice, or they've emailed the invoice to numerous folks. Weeding them out takes time. Now, you may think, well, we'll just weed them out and we'll move right on, and that's fine. You probably will. But it is critical that you understand that this weeding out process takes time and effort and uses up some of your valuable resources. And number two, that occasionally several of these duplicate invoices slip through and a duplicate payment gets made, and therefore you need to also focus on your duplicate payment recovery efforts afterwards. Okay. Accounts payable operational issue number two, which is related to the first one. Sometimes people say, well, if we make a duplicate payment, not such a big deal. The vendor will return the duplicate payment. And the answer is maybe 1 out of 100 of those suppliers will automatically return that duplicate payment. Most won't. Some will give you a vendor credit, and that creates other problems, and it takes a little bit of time to find those credits and then use them. And others just will silently pocket the money and move right along. So don't assume that your vendors are going to help you solve that problem. Accounts payable operational issue number three. Criminals are focusing on accounts payable like never before. They figured out that that's where the money is, and therefore they are targeting the staff in accounts payable to try and get them to pay them erroneously. Therefore, it's important that your staff continually be updated on new frauds and new fraud protection routines. AP operational issue number four. And this is, to my way of thinking, it's a simple one. Of course, not everybody agrees with me. If you want to improve the morale of maybe 95% of your staff, find a way to let them work remotely from home at least 1 day a week. Most, but definitely not all, folks who work in accounts payable would love to work remotely, and even allowing them to do it 1 day a week will raise morale. It's a simple thing to do, and honestly, I don't understand why 100% of companies out there aren't doing it. Now, there are a few people who don't want to work remote, and it won't help with them, but overwhelmingly, folks want to do that. Accounts payable operational issue number five. Some suppliers know which of your staff they can manipulate into paying them early. And trust me, when they figure out who those people are, they will take advantage of it. They'll call up and they'll wheedle and they'll say whatever they have to say to get your staff to pay them early. Now, they may need the money, and that's understandable, but your accounts payable staff works for your company. You don't want to pay them late, but you don't want to pay them early either. So if you're a new manager, you want to keep your eye on that. Accounts payable operational issue number six. Purchasers don't always approve invoices in a timely manner, and this makes it difficult for your accounts payable staff to get invoices paid on time. So if your suppliers are complaining that you're paying late, and you don't have a policy of paying late, and you want to investigate and make sure that your AP operation is working efficiently, but again, they can't process those invoices until they get them back approved. So you may have to have some conversations with purchase. AP operational issue number seven. This one kind of blows my mind, but it is what it is. Suppliers don't always respond to inquiries regarding discrepancies on their invoices in a timely manner, and this makes it difficult for you to pay them on time. So when your invoice processors are handling the invoices and they come across a discrepancy, they'll either call or email the supplier trying to get the matter resolved. And if the supplier doesn't respond, then they can't process the invoice and they can't pay them. So then when the supplier complains, hey, you didn't pay me on time, your response is, well, hey, you didn't respond on time. If you'd responded to our inquiry, we would have been able to. This also, by the way, will sometimes make it difficult to earn those early payment discounts, which, companies generally want. AP operational issue number 8. A good percentage of invoices have some sort of a discrepancy on them requiring manual intervention to get them processed. So even if you're using an automation solution, the automation solution may take care of some of your transactional work, but not all. And typically when there's a discrepancy either between the purchase order and the invoice or the receiving document, you need to have some sort of human intervention to get that matter addressed and handled properly. And you'd be surprised the number of invoices that require this. So while automation is great, and you may think, well, we'll just automate and then we won't need our AP staff. It's not the case. Okay. AP operational issue number 9. ERP systems do not catch duplicate payments or duplicate invoices as often as you think, despite the fact that most ERP systems have a feature that will not allow the same invoice number to be entered more than one time. And you think this would be the silver bullet that would stop all sorts of duplicate payments, but it's not. Yes, it does catch some of them, but number one, this assumes that the invoice number was entered correctly the first time, which is not a safe assumption. After all, if I was processing an invoice, I'd be more concerned that I got the dollar amount right and the purchase order number right, less about the vendor's invoice number. So there's that issue. And also there's the issue that many processes, when they run into, they enter the invoice number and the system says this invoice number has already been entered, they fudge around it because they think, well, that was a mistake the last time. This is the right invoice. And then they add a space or a dot or something, and they force the invoice through. Ongoing problem, one that we all have. And accounts payable operational issue number 10. And we're going to have some managerial issues also that many of us don't think about. But before I get to that, let's do AP operational issue number 10. Suppliers, amazingly, often leave critical pieces of information off an invoice, making it difficult for you to pay them on time. Now, to me, this is mind-blowing that they do this, but in conversations and in surveys that AP now has done with accounts payable staff, overwhelming number, a whopping number of them get a certain percentage of their invoices missing the information they need to get them paid to pay them on time, and so then they have to call or email the supplier. And as we've already discussed, suppliers don't always respond in a timely manner. Go figure. Now, as you may have noticed, automation, while it helps make accounts payable more efficient and effective, will not eliminate all these problems. And they certainly don't help with the unique managerial issues related to accounts payable. And we're going to take a look at several of them. But before we get to that, if you're getting any value from this talk, I would appreciate it if you give us a thumbs up. This lets me and YouTube know that you're getting some value from this, and we should produce more content like this for more people like you. Okay, let's talk about a few managerial issues. Managerial issue number 1, uniquely related to accounts payable and maybe some other transactional jobs, finance and accounting jobs. Number 1, it's the fear of losing their job to automation and artificial intelligence, AI. Now, most of your staff won't say this, but they'll throw up all sorts of roadblocks when you try and implement new technology, when you start talking about AI. And the answer to this is to explain to them that these are tools that will aid them being more efficient and effective in their job. They are not meant to replace their job, and so that if they learn how to use them, they'll become more efficient and effective. And it's critical that they do, so that if the time does come where the company needs to reduce staff, they're going to hold on to the people who can do the most for them. And the people who can do the most for them are people who know how to use these tools. Managerial issue number 2, and the only other place you're going to have this is in AR, is many times you'll have invoice processors handling the same accounts year in and year out. And this is a good thing in that they come to know the account, they come to know the people on the other end of the account, and when there's a problem, then they can work it out, and they have somebody to go to. This is all good news. The bad news, and it completely negates any of the good things that I was talking about, is occasionally the two folks will become friendly, the AP person and the AR person, as we mentioned, and yet they help each other. And in fact, in this case, they help each other to defraud one or both of the organizations. They collude together. So you need to periodically move invoice processes to accounts, assuming you have enough processes to do that. And managerial issue number 3, and this revolves around mandatory vacations. Everybody who has anything to do with your money, and this includes your accounts payable staff, should be required to take 5 consecutive days off, during which time somebody else does their job. They shouldn't do it from home. And the feeling is if there's an ongoing fraud, the fraud will unravel in this period of time. Now, I understand that this can make it difficult if you have, if you're only getting 2 weeks vacation, only giving 10 days vacation, and sometimes people will take 2 days here and 3 days here and a day here. And while I understand that, you want to have this mandatory vacation policy. I'm going to tell you that both that and the moving the invoice processes. While they are recommended best practices, they are not widely used. I've had a number of accounts payable managers tell me that their problem with vacation time isn't getting people to take them, it's that people want to take too much. But the trick here is those 5 consecutive days. When accounting professionals take over accounts payable, they think, I know this stuff. How complicated can it be? They clearly don't realize all the problems that we've already been discussing. And then they get themselves into a boatload of trouble because, as you know, or at least once you become intimately involved with accounts payable, you will know accounts payable is all in the details. It's not a big picture issue. Yes, there are some big picture issues, but it is all in the detail. That's why a good understanding of the basic principles is critical. Chapter 7, Best Practices in Accounts Payable. Best practices provide the tactical framework that can transform your accounts payable operation from a routine function into a powerhouse of financial control and operational efficiency. Whether you're a seasoned professional looking to optimize your existing processes or a new manager looking to understand the nuances of accounts payable, a good grasp of best practices and the role they play is critical. Today we're going to take a deep dive into best practices in accounts payable, starting with an evaluation of exactly what makes up a best practice.
What is a best practice? What makes something a best practice? And do best practices change over time? Are frequent questions asked by accounts payable, accounting, finance, and treasury professionals. Webster's dictionary defines a best practice as a procedure that has been shown by research and experience to produce optimal results and that is established or proposed as a standard suitable for widespread adoption. Wow. Now, what does that mean when it comes to accounts payable, or for that matter, any other accounting function? It is a practice that, and this is in an order of importance, okay? Number 1, includes tight controls, okay? It puts controls on the process. So the controls will help you fight fraud and other poor outcomes, such as if you're in accounts payable, duplicate payments, multiple entries in the master vendor file for the same vendor. If you're in HR, you might say it is a practice that means the company complies with all state and federal regulations while keeping employees motivated. That might also apply to AP and accounting also. Okay, so control. There's a lot of controls around whatever is being proposed. Next issue, efficiency. The practice that's being proposed or that's being established as a best practice must improve efficiency, of course, without giving up controls, okay? So it has to be a more effective way of doing whatever the particular task is, not just that it's some new, high-fangled, high-tech, whatever it is, okay? So it must make your whole process more efficient. And by the way, when we talk about efficiency, we're not only talking about the one particular task at hand, we're also talking about the function as a whole. So sometimes, especially in accounts payable, somebody will propose a particular change, which might make that person's job more efficient, more effective, but creates problems down the road. And my favorite example of this is, for example, if your AP folks are doing your GL coding and somebody realizes that it would be much easier to code everything to miscellaneous instead of going and actually finding out what the correct GL code, well, that might improve the efficiency of getting invoices processed, but it certainly would make your accountants less efficient when they had to go and figure out what was the right code, when they had to find these items, and of course, when it came to your financial statements and other reporting that was it's being done. So it must make the process more efficient, and everybody, not just one person, because we're not an island. We're all in this together. Next issue is revolves around reporting, and it should improve either the efficiency of your reporting or the accuracy. Okay, so going back to my GL example, when you code everything to miscellaneous, that does not give you accurate reporting. It doesn't give you a good picture of what's going on. Yes, you know what's being spent in total, for example, but you don't know where it's being spent and if it's being spent effectively. So you want to keep in mind whatever reporting is being done. Okay, next issue, and one, that is often overlooked, but it's becoming increasingly important, and we need to all focus on it, and that is regulatory compliance. Whatever the new practice is or the best practice is, it absolutely must incorporate the necessary tasks that will permit accurate and efficient regulatory reporting. way. So going back to my favorite accounts payable example, when we have our accounts payable process, one of the things that's recommended best practice is that a W-9 is collected from every supplier. Now, this certainly, when you're talking about setting up a vendor and getting an invoice paid, doesn't make the accounts payable team that's working on it more efficient or more effective. It's going to actually take more time instead of less time. But again, we've got to look at the operation as a whole, not just our one little task. And so getting the W-9, even if it means going back to the vendor several times to request it, is a best practice, because we want at the end of the year to be able to produce our 1099s, and we want to be in compliance with all state and federal rules. And by the way, when we talk about regulatory compliance, it's not only on the federal level, it's also on the state level. And in a few cases, we're also talking about cities. Okay. All right. Next issue. And this relates around cost and expenses. Okay. Ideally, it will reduce costs. Now, this may not always be the case. So, for example, collecting that W-9 certainly doesn't reduce your costs of setting up a vendor or processing an invoice. Also, some of the new verifications that we insist on accounts payable teams doing regarding change of bank account requests that might come in by email, that certainly does not make your process more cost effective, although it does make you more effective in total, because you're not going to fall for a fraud. So it's tightening controls. So that's why we want to look at costs. They are a factor, okay? And for example, that was why when we first started seeing invoice automation models over 20 years ago now, I've been looking at this stuff for over 20 years, that was nowhere close to being a best practice, because those models cost, $1 million, $2 million, a lot of money, okay? And unless you were a huge company, that did not make sense. Now, we know a lot of that has changed today, and so for many, but not all, automation may be a best practice, okay? So we've got to keep cost in mind, all right, but not necessarily realize that in some cases it won't reduce costs because of the other issues we've discussed. Now, I promised to describe the one fact that should not override everything else. I'm hoping that you've already figured out from what I've said so far that cost reduction or expense reduction, while is absolutely desirable, let me make it clear, I am all in favor of lower costs, but it should not be the driving force causing organizations to ignore other components, like the control issue that we discussed, or I've discussed in detail, okay? That could turn out in the long run to be a very costly decision. So, for example, going back to my example about verifying change of bank account requests. Yeah, that takes time, which then time translates into money. And you may, verify 50, 100, and you may say, you know what? Every time we call up and we try and verify, they say yes, it's correct. So you know what? We're going to stop doing that, because it's wasting time and we're not getting anything out of it. And then that one time that you don't verify, it turns out you send $1 million to someone and you can't get the money back. Okay, so not cost effective in the long run. Okay, so yes, cost expense reduction really important, especially today, but don't let it be the number one factor that causes you to lose sight of some of the other things that we do. Now, as far as best practices being written in stone, the answer to that is no, they definitely are not. And why is this? Because we have new frauds, new technology, new regulatory reporting requirements that mean we need to continually be on our toes to identify these new issues and adapt.
Let's start by addressing one of the biggest headaches facing virtually every accounts payable group: the massive amount of duplicate copies of invoices they receive.
We talk a lot about duplicate payments, but not so much about duplicate invoices. This is unfortunate, as one of the unsavory outcomes of receiving more than one copy of an invoice is a duplicate payment. Talking about duplicate copies of invoices. AP now estimates that 25% of all invoices received by companies are duplicates, and they're duplicates of invoices that are not past due. They're just multiple copies of the same invoice, either emailed to several different people or emailed to and mailed, put through the snail mail. Okay, this has become a huge problem because it creates a lot of extra work for the accounts payable team, non-value add work, by the way, that virtually no company is adding staff to handle. And occasionally those invoices slip through, those second copies slip through, and a duplicate payment is made. And as you know, duplicate payments are rarely returned. But I'm not going to go down that road just now. Okay, so what can you do? There are steps that you can take, and I'm going to go through them. They're pretty easy. Number one, encourage your suppliers to email invoices and email invoices only. This eliminates the snail mail. It gets that paper out, and it will eliminate some of the duplicate copies of your invoices. Not all of them, because you're still going to have the folks who email it to several different places. And of course, when you encourage your folks to email invoices, you're going to give them an email address, a unique email address that takes only invoices, is not used for anything else. Okay, so encourage emailed invoices only. Big emphasis on only. And there are some other benefits for that, but I'm not going to go off on a tangent, or at least I'm going to try not to. Step number two, weed out the duplicates as early as possible in the process. And the reason for this is the earlier that you weed them out, the less time you waste processing them, because the last thing you want to do is go through all your different steps of processing them and then at the last minute realize, oh, this is a duplicate, and then you have to throw it out. Better than making the payment, definitely, but a lot of wasted effort for no added value other than you didn't make the duplicate payment. Okay, next step. It's pretty simple. Ask them to stop. Once you've figured out who these people are who are sending multiple copies of invoices, you can just ask them to stop. You can either call up or you can send an email requesting only one copy of the invoice be paid. Now, of course, if it's after the due date, the vendor is within their rights to send a second copy of the invoice, but that's not what we're talking about. We're talking about organizations that pay on time through the normal course of business, getting 3 copies of the same invoice before the due date. Okay, so ask them to stop. A little extra effort, but it will pay off. Next step, after you've asked them to stop and they keep doing this, identify the repeat offenders, okay? And you want to identify these repeat offenders because you're going to have to give them some extra special attention to make sure that you don't double pay. So identify these repeat offenders, and I'll tell you what to do with them a little bit later. You also want to identify, and this can be a real problem, those sneaky suppliers who send the second copy of that invoice, not in the beginning when they send it to 4 different people, but either on the due date or right before the due date. And they send the second copy, I believe, many of them, with the hope that you'll think it's a rush, you'll think you've missed the invoice, and you'll make a second payment, okay? Now, sometimes if you've talked to them, they'll say, well, it's just a reminder. And, my instinct is to say, well, don't remind me unless I haven't paid. Don't help me, because your help isn't really help. You have to be a little bit more polite than that, okay? But you want to identify these guys, and you really want to keep a close eye on them because you may make a duplicate payment. Our next step is, once you've identified your repeat offenders, be they just repeat offenders or these sneaky guys setting them at the last minute, you want to have another conversation with them, and I call it threaten, but you probably be a little bit more polite than me, to put them on the ACT list. I call the ACT list the always check thoroughly list. This is a list of vendors who you're going to double check every single one of their invoices before you make a payment to make sure that you don't duplicate pay it. And the end result of this, you might share with them, is that the payment will be delayed because you're having to do this double checking. Now, you can say it nicely to them, but at the end of the day, you don't want to make a duplicate payment. And if you need to do this double checking, they end up delaying their payment. And that is not what they want, because after all, at the end of the day, well, yeah, it would be nice if you pay them twice. Really, what they're trying to do, most of them, is just get paid. And so the best way in this case to get paid is not to send multiple copies of the same invoice. Okay, so now after you've done all this, you've gone through all your steps that I've suggested, maybe a few of your own that you've come up with. And if you have some extra tactics that might work, feel free to share it in the comments below so that we can all benefit from this. And you've got your list now. You're not getting so many duplicate copies of invoices, and you can rest on your laurels, right? Wrong, because these duplicate invoices, I like to say, are like weeds. No matter how much you work on them, you pull them, you try and train them to do the right thing. no matter what you do, you can never get rid of them completely. Companies that send them will either, maybe they hired a new person, and that person comes in and they think, oh, this is a great idea, or somebody comes up with this idea, or a company that wasn't sending duplicate invoices now starts doing it. So the problem never goes away. You just have to stay on top of it, just like weeds, to try and make sure that you keep it under control. Because when you go and you ask a company to stop sending duplicate copies of invoices to you, and even when you threaten them and you say, well, hey, we're going to put you on the act list and this is going to ultimately end up slowing down payments, if it is their policy and their procedure to send these duplicate invoices, in all likelihood, they are not going to make this one change just to accommodate you for your special requirements. So you got to stay on top of it. So repeat, go back, encourage the emailed invoices, talk to them, identify the offenders, and keep at it. And maybe someday we'll get to the point where this isn't an issue, but I don't see it in the next few years.
Since accounts payable is all about invoices, let's review some of the best practices around invoice processing. Invoice best practice number 1. Procedures for handling invoices should be standardized. Everybody should do everything exactly the same way. That way, if an invoice comes in today and I process it, and one comes in 2 weeks from now and you process it, you'll be able to identify it as a duplicate fairly easily. Invoice best practice number 2. Annually, the manager should review the work of each processor to ensure compliance with those standardized instructions. Any shortcuts should be investigated. This does not have to be a big formal process. Just go, the manager or who's ever doing the review should just go and sit with the processor, tell them just keep operating the way you normally would, and then watch how they do it. Are they using the standardized procedures that you've outlined for them, or have they integrated a shortcut that they've come up with? If they've integrated a shortcut, you want to investigate. Oftentimes those shortcuts will make their job a little easier but create a problem down the road. And if that's the case, if you have a control problem, for example, or someone else isn't able to do their job because of this shortcut, then you want to cut it off, you want to stop it. But if this shortcut turns out to be actually good, then you want to use it, you want to integrate it into your processes and make sure all your processes are using it. Invoice best practice number 3. Centralize the receipt of invoices with one special email address just for invoice, a very specific snail mail address for those folks who are still mailing their invoices by paper, and a fax address just for invoices because some people are still faxing invoices. And ideally, by the way, if you do have that fax address, you want to tie that up, match it with an e-fax facility that will convert that paper faxed invoice into an electronic document that's emailed, and you can be processed from there. Which brings us to invoice best practice number 4. Push for electronic receipt of all your invoices. By electronic receipt, I mean either using your portal or your automation solution, or, and this is how most of the invoices are coming in today, invoices should be emailed. So you remember the separate address that I told you to set up. Invoice best practice number 5. When selecting an automation solution, make sure it can read PDFs that are emailed in. That way, you don't have to harass your suppliers to change their process, which you know is always a nightmare. They can just continue emailing you their invoices as they have been doing it, and then you don't have to get them to change anything, because as you know, getting a supplier to change is often not easy. Invoice best practice number 6. Ruthlessly weed out duplicate copies of invoices. Unfortunately, we're in a situation now where some suppliers have realized that email costs practically nothing, and so they'll send multiple copies of the same invoice. This creates extra work for your accounts payable staff, and if you're not really on top of it, it will also create a duplicate payment. So you want to be really ruthless about weeding out those duplicates. Invoice best practice number 7. You want to identify those suppliers who are sending duplicate copies of the invoice or triplicates or whatever, and you want to ask them to stop, but if they don't, you want to double check all their invoices, and in fact you can even tell them, hey guys, if you don't stop sending double copies, we're going to have to put you on our special list that will where we double check, and that will probably delay your payment a day or two, and they're not going to want that. Invoice Invoice best practice number 8. You want to have a coding standard and you want to insist that all your processes use that coding standard, even if you are automated. Why? Because even if you're automated, there's still a certain amount of manual data entry that needs to be made. There are corrections that have to be put in, and you'll still be getting some paper invoices unless you're really, really lucky. And you want your people to stick to the coding standard for the reasons that we used it in the past. It helps reduce duplicates. Invoice best practice number 9. When your processes are handling invoices, you want to use the three-way match so they can identify potential problems on the invoices. Okay, that's your best way of weeding out invoices that have inaccuracies on them. And we've got several other videos on the three-way match, and I'll put a link to them in the description in case you want to investigate that more. Invoice best practice number 10. When your processes are processing invoices, they're going to have some that have discrepancies and need to be followed. The manager should track this and follow up to make sure that these discrepancies are being resolved, because if these discrepancies are not resolved in a very timely manner, a second copy of the invoice will be sent. That's extra work for you guys, and sometimes those second copies get paid. So follow up on discrepant invoices, and if you can at all possibly do so, get them resolved before the payment date so that the payment is made on the due date, and then you don't get that second copy. Invoice best practice number 12. When discrepant invoices are resolved, and hopefully you're tracking this either in your ERP system or maybe in a spreadsheet, you want to make a note of the cause and then track this, as I said, in the spreadsheet. Periodically, then you want to go back and review it and see if you can identify root causes or root problems. Let's say you had 100 discrepant invoices and 25 of them had the same problem. Well, you want to look at that problem and say, what can we do to fix it? Oh, all these invoices were a result of POs coming out of our Duluth office. Maybe our Duluth office needs a little more training on how to put together POs, or whatever it is, okay? So you want to fix the problems that are the biggest ones and also the easiest ones. Even if you only have 2 or 3 invoices with this problem, it's really easy to fix it. Just go ahead and do it. Periodically, you want to do this analysis. This is not a one-shot deal, because even though you'll maybe do the analysis, you'll get most of your problems fixed. This redoing the analysis will help you identify new problems that may have cropped up, and you know there's always new problems on the horizons, as well as, and this pains me to say, old ones that may have returned. Just because you think you fixed the problem once doesn't mean that 6 months or a year from now it's not going to be back, especially if you have a turnover in staff, or there's a turnover in staff at one of your suppliers, because who knows what's going on there, and of course you have no control over that. Invoice best practice number 13. Invoices with early payment discounts should be tracked, identified, and fast-tracked so that you earn as many of those early payment discounts as you possibly can. I had one accounts payable professional tell me one time, the only mortal sin in our organization is missing an early payment discount. It's the best financial return for your organization, and you want to make sure you get as many of them as you can. And for a really selfish reason, if you're losing a lot of those discounts, you can better believe somebody in finance is going to realize it and do a little analysis and point it out at a time just when you don't need them to be pointing that out. Invoice best practice number 14. Insist that your suppliers include the purchase order number on their invoices. Now, you think they would automatically do this, and many do, but there are a few who don't, and that makes it more difficult for your processes to figure out who to send the invoice to for approval, and also to do the three-way matching, and also to extinguish the right purchase order. So if they don't include it, just send it right back to them and say, we need the invoice to include the purchase order number. Yes, that will take a little bit of extra work, but doing a little bit of extra work now will save you time in the future as they submit many invoices you want them to have. So insist on the purchase order number. Of course, this assumes that you issued a purchase. Invoice best practice number 15. Once an invoice is processed and scheduled for payment, the related purchase order and receiving documents should be extinguished immediately. No waiting till the end of the week or the end of the month or when you have time. Immediately. That will make it less likely that if a duplicate copy of the invoice shows up, it will be paid. Invoice best practice number 16. Invoice processors should not update the master vendor file. file. You should have a separate person to do that, because if your processes are doing it, it is a violation of the appropriate separation of duties principle, which is the bedrock of our strong internal controls, fraud prevention, and duplicate payment protection. So your invoices should not be updating master vendor file. I know a lot of people do this. It's easy, but it's not the right way to do things. Sometimes the right way is not the easy way, as I'm sure you've noticed before. Invoice best practice number 17. Don't leave processes handling the same accounts year in and year out. You want to periodically rotate them. This is because if you leave them on the same accounts, there's a chance that they'll become friendly with the processor on the other side, with the accounts receivable person, which is great if you have a problem, but not so great if the two of them become so friendly they collude and then they defraud one or both of the organizations. So periodically rotate them. Along the same line, best invoice practice number 18, require that anyone having anything to do with your organization finances, and that includes processing invoices and the master vendor file, that they take 5 consecutive days off, during which time someone else handles their task. It's general consensus that if there is an ongoing fraud, it will be uncovered during that time period. So don't let them do the job from home. That completely negates the whole purpose of having them take the 5 consecutive days off. And invoice best practice number 19. Invoices should never, ever be paid by an individual personally and then put in for reimbursement on their expense report. For if they do that, it will be virtually impossible for you to identify a duplicate payment, because when that invoice shows up in the in the normal course of things, your processor is going to go process it, the purchase order is going to be outstanding, the receiving document is going to be there, and they're just going to go ahead and pay it. And as you know, very few vendors automatically return duplicate payments. So do not let anybody do that. And if they do it, you make a big to-do about it and basically tell them if they ever do it again, they're not going to be reimbursed. And then immediately make sure the purchase order and the receiving document are extinguished and your accounting records are updated appropriately. Now let's take a look at some best practices in accounts payable that address issues other than invoices. Sadly, there are some best practices that are ignored by over 80% of all organizations. Does this mean you can safely ignore them as well? No, absolutely not. Unless you are happy explaining to management why you had so many unrecovered duplicate payments and why the team fell for a fraudulent scheme and you can't get their money back. We'd be remiss if we didn't identify those practices no organization can afford to ignore. By their very nature, best practices incorporate strong internal controls. You can't have a best practice without them. We think that an understanding of internal controls that underlie best practices is so important. We did a video on that very topic, a short video. You can watch it right now using the link that has appeared on your YouTube screen and is in the description. Good luck. There are certain basic best practices you absolutely cannot afford not to use. We're going to identify 10 of them and explain what can go wrong if you choose to ignore them and not incorporate them into your basic process. As some watching this might be aware, I'm the author of over 20 business books, most of them focusing on the accounts payable function, including 127 best practices for accounts payable. While I'd love it if every company would use all the best practices I talk about, I realize that in the real world, the one we all live in, that is not likely for a variety of reasons. But the 10 we are about to discuss are vital, for without them, the bottom line, i.e. your profitability, will suffer, and in a few extreme cases, the losses will be so severe the company will not be able to continue. Don't let that happen at your company. Make sure, at a minimum, the following are used. Must use accounts payable best practice number 1. Set up one central email address for the receipt of invoices and invoices only. If you allow invoices to be sent wherever the supplier chooses or guesses to send them, they will A, send multiple copies to different people, or B, email and snail mail the invoice, or C, email them to an individual who may or may not get around to forwarding that email to the accounts payable team for processing. What's more, individuals take holiday, get sick, and sometimes just forget. They also leave the company. Of course, while the supplier may not have sent the invoice to accounts payable, They certainly know enough to call accounts payable when it's not been paid within the time frame that they deem is reasonable. The end result is that process works more smoothly for everyone involved if they just send the invoices to accounts payable and send only one copy of that email directly to the centralized email address. Must use accounts payable best practice number 2. Get a W-9 from every new vendor. Now, sometimes the supplier will assure you that they don't need to provide you the W-9 because they're not reportable. They may be right, they may be wrong, but it is your company that's going to get hit with a B notice if they are wrong. And it is your company that's going to have to pay the associated fine. And it is your company that will now have raised its profile with the IRS as one that's not compliant with IRS guidelines. So get the W-9 from every single vendor and do the verification yourself. They could be right, they could be wrong, or they could just be trying to pull a fast one so you don't report their income and they don't have to pay income tax on it. There is one last reason to get that W-9. Some of you may remember, even if you're trying hard to forget it, that at one point over 10 years ago, there was talk of having to report all income to the IRS on 1099. That was repealed, but most tax professionals believe it will someday come back, and you want to be ready by having collected all your W-9s. Collecting the W-9s is just the first step. There's more. Must use accounts payable best practice number 3. Run every W-9 information, the information on the W-9, through IRS TIN matching to ensure that the information provided by the supplier is accurate, i.e., the name on the W-9 matches the name the IRS has on its records associated with that particular TIN. The TIN, in all likelihood, will be an EIN for an entity or a social security number for an individual. Don't wait until year end to run this information through IRS TIN matching, which is the free service from the IRS. Do it as soon as you receive the information and before you make the first payment. That way, you are in the driver's seat and can get the supplier to correct the information if it is not correct, because they want to get paid. Must use accounts payable practice number 4. Set up and insist everyone on your staff use the strict coding standard for entering both invoice data and setting up vendors in the master vendor file and making changes to the vendor file. You need this even if you're using an automation solution for invoice or accounts payable processing. Why, you ask? Because even with an automation solution, your folks will still have to do some data entry. They will have to put through corrections, and as many have discovered the hard way, utilization of automation solutions is not 100% right off the bat. So don't let your folks introduce errors because they aren't using your standardized data entry protocols. Must use accounts payable best practice number 5. Use the 3-way match when processing invoices to ensure that invoices aren't paid twice, the correct amount is paid, and the correct price is charged, and no extra fees are tacked on that had been negotiated to be paid by the seller. Also, this is one of the best ways to catch phony invoices or fraudulent invoices, for there'll be no purchase order or receiving document to match again. Must use accounts payable best practice number 6. Use positive pay to protect against check fraud, since in all likelihood, if you're watching this and you're a U.S. company, you are still issuing paper checks. If your bank offers it, take advantage of payee name positive pay, as it adds that extra level of protection against someone stealing one of your checks and altering the payee name. Even though there is a huge push towards electronic payment, there are many new types of electronic payment fraud. Check fraud still remains the most commonly attempted type of payment fraud. Thanks to positive pay, not many of those attempted frauds make it through. So, protect yourself fully by purchasing a positive pay product from your bank. Must use accounts payable best practice number 7. Verify anything out of the ordinary before executing the change. The most vicious of these frauds in recent years is the plethora of phony change of bank account email requests that have been inundating accounts payable departments everywhere. But this is not the only type of fraud to be on the alert for. Anytime there is anything that is outside the normal way you operate, verify it before executing. Don't think that you're too small, that it wouldn't be worth anyone's bother to try and defraud your organization, or too big and crooks wouldn't dare try. Neither is true, as both big and small companies alike have learned, unfortunately, the hard way. absolutely everyone is a target. Before we get to the last few best practices, including one that sadly is frequently ignored, if you find this information useful, it would be helpful to me if you would hit the like or the thumbs up button. It sends a message to both this network and me that this content should be shared and more like it created. A big thank you from me to you if you're one of those individuals who hit the like button. Must use accounts payable best practice number 8. Aggressively move away from paper checks. They are expensive, require lots of manual effort, and are generally an inefficient way to operate a payment function. Those efforts could be used on more value-add tasks, like verifying those change of bank account requests are valid, doing the increasing amount of regulatory reporting now required, or perhaps even some of the analytical work that can help you run a more efficient and effective department. You may just be surprised to find out how many of your suppliers are receptive to receiving an ACH payment instead of a paper check. I'm pleasantly surprised, I might add. Must use accounts payable best practice number 9. Daily bank recs are a must if you wish to recover any funds associated with an unauthorized ACH transaction that was executed against your bank account. While individuals have a longer period of time to refute such unauthorized charges, entities, which is anyone who's not an individual, have only 48 hours from the time the transaction hits the bank account. The fact that you didn't check your account in that time period is unfortunately irrelevant to this consideration. Since many only check their accounts once a day, assume the worst case scenario, that the transaction hit right after you checked your balances, and conduct daily bank recs. Some best practice organizations will actually check several times a day to ensure that no unauthorized transactions slip through. Must use accounts payable best practice number 10. Appropriate separation of duties across the entire procure-to-pay chain is an absolute must. For without this separation, the necessary checks and balances are simply not in place. With technology making serious inroads into the accounts payable department everywhere, accounts payable departments are getting smaller and smaller. Why is this such a big deal? Because if one person has access to more than one leg of the procure-to-pay process, it becomes much easier for that person to defraud the organization. Will most do this? Absolutely not. But the problem is you don't know which employee is the one that has that dishonest streak. Time and time again, when there is an internal or occupational fraud, the perpetrator ends up being a long-term trusted employee, the exact type of employee that sometimes gets access no employee should have. There are certain best practices in the accounts payable process that many companies skip over. They think, they take too much time and they are not really necessary. It would force them to step out of their comfort zone, sometimes put them at odds with management or other employees, or require additional training. But then when disaster hits and management wants to know, how did this happen? Or why didn't you catch this sooner? They don't have a good answer. Don't let this happen on your watch. Let's take a look at 5 of these ignored best practices. We'll discuss what they are and why it is critical that you use them. Ignored best practice number 1, daily bank recs. That's right, bank recs on a daily basis. Not doing this can literally cost your organization millions of dollars. I'm not exaggerating. Let me explain. If there is an unauthorized ACH debit against your account, you have a very short, limited period of time in order to notify the bank and have that transaction reversed. You have 48 hours from the time it hits your account. I like to tell people you have 24 hours because you look at your bank balances this morning, let's say at 9 o'clock. A lot of companies will have someone who looks at it first thing in the morning, and everything is fine. So you close out the bank balances and you go about the rest of your business. At 9:01, an unauthorized transaction hits your account, but you don't look at the account again until tomorrow. So you've already wasted 24 hours. Daily bank recs are critical. And I also have to tell you, it's easier to do a daily bank rec when you only have a few items to reconcile against than a monthly one where you have hundreds or even thousands to try and find the problem. So you benefit on both ends. So daily bank recs, you don't want to not do it. Ignored best practice number 2, and this one boggles my mind. Company card retrieval when an employee leaves the organization. This one won't be as expensive as the first one, but it's likely to enrage management when it happens. So here's what happens. When an employee leaves the company, most companies are good about retrieving the company credit card, but they don't take the second step, and the second step is critical. The second step is canceling the card with the bank. If you don't cancel the card with the bank and the employee uses the card to charge something, you're still going to get charged for it, and you're going to have to pay. And then trying to get that money back from the employee is often difficult. If an employee has gone out of their way to write the card number down, the expiration date, and the 3-digit code, then they're going to give you a hard time about returning the money. So don't have this problem. Make sure HR notifies the card, whoever manages your card program, so they can notify the bank immediately and cancel the card. Did you notice a theme here? Not using the best practices I'm discussing costs company big time. Money that comes right off the bottom line makes the organization less profitable than it might be otherwise. If you're interested in learning more of this type of information, the business intelligence you need to run a more efficient and effective accounts payable function or manage it, and make yourself look good to management in the process, please hit the subscribe button and please give us a like. It helps both us and YouTube know that the content is valuable and it should be spread to more people, and we should make more like it. Ignored best practice number 3. You want to rotate your employees who deal with your outside either customers or clients on a fairly regular basis, like once every 6 months. When we're talking about the accounts payable function, we're talking about rotating your processes. Now, this is one that many people just think is a waste of time until they get hit. Now, I'm going to be the first to admit this doesn't happen often, but when it does, like tornadoes and earthquakes, the damage is horrific. So you want to protect yourself against it, and there are many other benefits from the step. Let me explain in a little bit more detail. I'm talking about rotating your processors so that they don't get too friendly with the person on the other end, the person at your supplier, so that they collude and they defraud one or both of the companies. As I said, it doesn't happen often, but when it does, it is a nightmare. And it's very easy to prevent. Just rotate your processes. The other benefit that you get when you do this is if you rotate your processes, then you have people who know various different accounts, and you have some sort of backup in case somebody is out or somebody leaves unexpectedly. There's a family emergency and they're not there. It doesn't cost you anything. Yeah, your employees are going to complain a little bit, but it's a best practice. And I have to tell you, the number of companies that do this is minuscule, but it really is a best practice. All right, I'm going to stop ranting and raving about that. I'm going to turn my attention to ignored best practice number 4. This involves mandatory vacations. And again, this is one that by doing surveys at AP Now, we survey our members and people who get our free easy and on a regular basis. And I always ask this when I do webinars, almost no one implements. And many times, at least in the United States, this is because companies are a little bit stingy when it comes to vacation time, and other people say it's not a problem. So this is the best practice. You need to make sure that everybody in your accounts payable department, basically anyone who has anything to do with your money, takes 5 consecutive days off, and during that time, someone else does their job. And the feeling is if there's an ongoing fraud, it will unravel during this time. Now, you should be aware that when there are these ongoing frauds, many times the employee who's perpetrating it won't take vacation because they need to be there to make sure that everything is covered. And these frauds can go on for years. So you don't want that to happen on your watch. So 5 consecutive days off. Many times this won't be a problem because your employees are already doing it. But occasionally you'll have an employee, for example, if you only give 2 weeks vacation, which is not that uncommon, you'll have an employee who has no big plans for the summer, and they'll decide that what they're going to do, and I understand this, is they'll take every Friday off during the summer, and they'll have some long weekends. That's nice, that's great, but it doesn't cover you on your mandatory vacations. So don't overlook it, because there's no reason not to do this. Ignored best practice number 5. This is to conduct a regular process audit of not only your processes, but also your individual employees. Just make sure that they're doing what you say they should be doing in your policy and procedures manual. Now, there are many numerous benefits from this. You uncover when people have incorporated shortcuts that actually don't have strong internal controls, and it's also a way to find out whether you're running the most efficient accounts payable function. But also, as you're doing this, it will help you detect a problem before it turns into a nightmare. That problem could just be a weakened internal control, or it could be an ongoing fraud. So this is something that you should be doing. It will help you run a best practice operation, and in a few odd instances, when you're doing this, it will also help you uncover fraud. Now, if your employees know that you're going to do this, you should, by the way, not tell them when you're going to audit their work. Just show up one day and sit there. If they know there are going to be these surprise audits, it can also serve as a deterrent so that your employees know, well, she's going to come and audit. We don't know exactly when. Maybe I should continue. Maybe I shouldn't try and defer. Chapter 8, Cutting Costs. If this is sparking joy in you, or at least not putting you to sleep, smash that like button. Think of it as your good deed for the day. Seriously, it helps us more than you'd think, and it's far easier than dealing with those nasty suppliers who try and trick you into paying them twice. And speaking of which, Chapter 9, Crushing the Duplicate Payment Headache.
There's a really simple reason we call duplicate payments the silent killer. They eat away at the profitability of your organization, making it difficult to figure out why the company isn't making as much money as everyone thinks it should. You might think that your company has an effective system in place to prevent duplicate payments, but in reality, it's much easier than you think for these costly errors to slip through the cracks. Don't play the blame game. You can reduce your duplicate payment errors by 97%. This has become a bigger issue in the last few years as the number of copies of duplicate invoices has skyrocketed. If you want to protect your company's bottom line and improve your financial processes, it is crucial to understand how duplicate payments occur and, more importantly, what you can do to stop them. The problem starts when your invoices first enter the company. So I want to start off with a story that kind of, I think, demonstrates how important the tactics that I'm about to share, which might seem awfully simple to you, are. I was at a conference and I was talking to a guy who was the VP of accounts payable for a large bank, very large bank. And he said to me, you know what? He said, we just had a payment audit done. And he said they only found $57,000 worth of duplicate payments. I said, oh, that's interesting. I didn't know the relevance of 57,000. I said, what'd they find last time? He said $2 million. They went from 2 million right all the way down to only 57,000. So quite impressive. So I thought, there's a story here for me. I said, how'd you do it? And he said, oh, that stuff, all that stuff you usually talk about. And then, we had a little bit of a longer conversation where he explained, and I'm going to share with you the 3 really, really simple strategies that they use, and you can also, okay? And they cost nothing. Strategy number 1, when it comes to your accounts payable processes, as much as this might be, go against the way you want to be, you need to become a control freak. You need to set out what you want your processes are, how you want your invoices paid, how you want vendors set up in the master vendor file, how you want payments scheduled, and every other feature around the process, and set them up so they have tight internal controls. And then you need to share them with everybody. This is one of those places where creativity is not desired. If someone thinks they know a better way to do it, let them suggest it to you. And if you agree, then you incorporate it into your processes and everybody uses it. But really, you need to be really on top of this. If you operate this way and then a duplicate invoice comes in, which they're coming in droves right now, then if I get an invoice and I process it today and a duplicate shows up 2 days from now and you get it, if we're going through the same steps, you'll be able to easily identify it as a duplicate, which is what you want. Okay, strategy number 2, as part of this standardization, if you will, you want to set up a coding standard. This tells people exactly how to enter the data. You want to do it for invoices, for invoice data entry, you want to do it for your master vendor file, and you want them to match so that people have an easy time when an invoice comes in finding the associated vendor in the master vendor file, and be very precise. This is really an area where you want to have no creativity, and everybody needs to do it the same way. You don't like to be this, do it the way I say, and this is the only way we're going to do it. But if you want to knock out those duplicates, which we're all dealing with in a big way now, it is crucial. Now, before we get to the last step, I'd like to share with you that at AP Now we have 350 videos, over 350, in our library, with new accounts payable and payment videos being added every Tuesday and Thursday, and some really short items on other days. Occasionally on Saturdays, we have a little Wordle fun. Please check out the rest of this channel after you finish this one. Okay, strategy number 3, and this step is often overlooked. You've set up your coding standards, you've set up your processes, and you give it to your staff, and you hope they're using it. But that's the key here. You hope. This is one of those, trust but verify. So after you've set it up and you've given it to your folks, periodically you want to spot audit. So just go and you sit with somebody and you make sure they're doing it the way that it's been laid out, and not some new way that they think is better or works faster. Because even if they have a better way, then if everybody else isn't doing it, you're less likely to find your duplicates. And if it is a better way, you want to share it with everyone. So don't forget not only to set it up, but to verify. And you want to verify every 6 months, every year. And maybe if you have a new employee, you want to verify with them a little bit more frequently, okay? You just have to sit with someone for half an hour, see what they're doing. It doesn't have to take a lot of time.
Chapter 10, Fraud Protection, some quick protection tips. Getting hit with a fraud when you're in charge can be devastating, even when you had absolutely nothing to do with it. What's more, management often feels that someone has to take the hit for what happened, and they terminate or demote the manager who was in charge, figuring that they should have had tighter controls in place to prevent this kind of thing from happening. That's why we put together this quick rundown of fraud protection practices everyone should be using. Issue number 1. I call this the issue no one likes to confront. I've been covering accounts payable issues for almost 25 years now, and whenever I mention this one, people get uncomfortable. Sometimes they give me dirty looks, but it is a fact of business life, so we need to address it, and we're going to address it now. When it comes to fraud can be both internal and external. That's right, it's not always some bad guy out there. Sometimes it is somebody that you know and actually like. This is why we make a big deal about internal controls across the board, no exception, because there is what I call the myth of the long-term trusted employee. Now, most long-term trusted employees are quite honorable, and they would never think of doing anything to harm their organization. But there's always that one bad apple. And in fact, surveys from the Association of Certified Fraud Examiners have shown year after year that when there is an ongoing fraud committed by an internal person, an employee, it inevitably is that long-term trusted employee, that person you think they would never do anything. So I'm going to stop talking about this, but I want to conclude this little section of this talk, if you will, with a hashtag from my colleague Kelly Paxton. She came up with this, and she says hashtag trust is not an internal control. So anytime you hear yourself saying, oh, that's Joe or that's Jane, we don't have to worry about it, you're probably right, but you don't want to take that chance that you're not. Okay, issue number 2. This is one that I call the high alert issue. And if I was doing this talk even a year ago, I probably wouldn't have mentioned it, but today it is critical, okay? And that is when you're, going about your day-to-day operations, anything that occurs that is different or out of the ordinary, especially when it relates to your money, you need to stop, you need to question it, and you need to verify it. And it's the little things, because criminals are quite good at they're figuring their way around. Let me give you a very simple example. If normally you're the accounts payable manager and you're doing the wire transfers, and it's always the controller who brings you the wire transfer, and this time you get an email from the CFO with the wire transfer directly, not going through the controller, and it says something like, "This is a rush. We need to hurry up and get it out." Maybe it is from the CFO, and maybe it is a rush and you need to get it out. But take a few extra minutes to stop and confirm, because I can't tell you how many times this little out of the ordinary that doesn't really seem that much out of the ordinary has been a fraud. Okay, issue number 3. I call this one yet another variation of this devastating fraud. And this actually happened in the town that I live in, so it's near and dear to my heart, or at least according to the newspaper it is. And the manager who was in charge was fired. So we all know that we verify all those emails that come in that have a change of bank account request, but you need to verify those changes regardless of how that request comes to you. So in this case, the hacking actually did not occur in the customers in the town's accounts payable system. It actually happened in the supplies and the accounts receivable department, or the billing department. And what the criminal did is they changed the invoices. So the invoices had a little statement on it that said, please send funds to our new bank account, and it gave the bank account number. And of course, people getting this, they received the email. It was from a legitimate source. It was from an invoice that they were expecting, and they went ahead and changed the bank account without verifying it. So even if it seems like it's ironclad, this has got to be accurate, go ahead and verify it. And because in this case it wasn't, and there was a lot of trouble afterwards. Okay, issue number 4. I call this the alert issue. You want to be alert for new frauds, and you want to be alert for them before you come victim. This is kind of a variation in the last tip, where the change of bank account now came on the invoice instead of the request coming through email. So keep in mind, criminals are really smart, or at least some of them are, and they look for weaknesses and they figure out ways to exploit them, ways that you and I would never have thought. So be continually alert, and if something looks a little odd, then you want to question it. Issue number 5. I call this putting on your hacking hat. Hacking hat. Can you say that fast 5 times? Okay. Annually, you want to become an ethical hacker, or you want one of your employees to do that. You want to keep in mind that when it comes to taking advantage, your employees know where your weaknesses are. And when I say your employees, I'm including ex-employees. And at the end of the day, you never really know who is disgruntled, who is having financial issues, or what weaknesses they may exist. So once a year, put on your hacking hat and see if you can break the system, so to speak. See if you can figure out a way that you could defraud the organization. And then, of course, if you figure it out, you want to fix that. A great way to do this, by the way, is if you hire somebody new, if you have a new employee, have them look through your system and see where they see the weaknesses are, because they are going to look at things with a little different set of eyes than you would look at it, and they also come from a little bit of different background. So that's kind of like getting a consultant for free. So don't overlook those new employees. Let them try and break your system. Okay, the next issue I call the non-discriminatory issue, and that is, I'm going to make it clear that when it comes to crime, everybody is a target, even in the corporate world. Okay, there's no exceptions. Criminals will take advantage of whoever they can. Some statistics from the Association of Financial Professionals showed that with these new electronic payment frauds, 61% of them were focused on the accounts payable staff. Okay, and depending upon the fraud, there's different targets, and I just want to go through a few of them quickly that we've seen in recent times. CFOs have had their emails either hacked or impersonated, and then an email is sent requesting a rush wire transfer. It's usually sent to somebody in AP or whoever within the organization is doing your wire transfers. CEOs have had their emails hacked and sending out requests for personnel information. In the most famous case, if you will, I hate to use the word famous in this example, but it is notorious that they got the W-9s. This problem has become so bad that the IRS issued a warning going to all companies saying, as a best practice, anytime there was an email request from a high-level executive requesting personnel information, tax information, that should be verified before that information is said, because there have been so many of these phony emails that unfortunately people fell for. The email came from the CEO or some other high-level executive. The employee wanted to look good, and so they immediately sent the information, unfortunately, to the criminal. Okay, your accounts payable department is getting inundated, and they continue to get inundated with both phony wire transfer requests, supposedly from the CEO or the CFO, as we've discussed, and also from criminals who are impersonating your true vendors, trying to get you to send a payment to one of their bank accounts instead of to the supplier, so they have to be verified. Payroll has been a target with these requests for personnel information, and then basically any employee. For the last few years, we have this gift card scam going on where the criminals send an email to different level employees asking them to go out and buy gift cards, and then the criminals can turn that into the information on the cards into cash, and either the employee or the company is out the money. Showing just how smart they are, one company told me they got hit several times with this fraud, and they couldn't understand it because they were updating. They were doing a good job at updating their employees, or so they thought, and then they realized what the criminals were doing is anytime they got a new employee who hadn't been there and seen the former alerts, they were targeting them. And of course, new employee want to look good, and you can figure out the rest. So now that organization had to make training about not falling for this gift card scam part of their new employee training. Okay, next issue. I call this the blabbermouth issue. I say this is the one time it's good to be a blabbermouth within your organization. Normally that's not a compliment, but as soon as you hear of a new fraud, spread the word and spread it quickly. Don't wait for the weekly staff meeting or the monthly staff meeting. It may be too late then. And as I hope I've managed to convey to you, it's important that you spread this word to everybody, not just the managers or the higher ups. Okay, so as soon as you hear about a fraud, even if it's one that you guys fell for, don't get hit a second time. Don't be embarrassed. Spread the word. And I love it when people tell me, because then I can be the blabbermouth and spread the word. Okay, and then the last issue, and this one, if only the employee had followed this, would have saved his organization $25 million. And this is trust your gut. Okay, I call this trust your gut issue. If something feels off, take a minute, step back, look at it, ask a few questions, make a few calls. In this case, it was a $25 million. It was in Hong Kong. The employee was instructed via a Zoom call that turned out to be a deep fake of the CFO to send money, which ultimately he did. But throughout the whole thing, he felt something was off. He couldn't put his finger on it, and eventually, when they figured it out, they went to the police, which is how I know about it, because it was in the press, and unfortunately, the money was gone. But felt something was just not right. So, as you can probably tell from our discussion about these issues, use of the most current best practices goes a long way to protecting any organization against fraud. But sadly, there are certain best practices that are still ignored. That is, they're ignored until disaster hits. And that does, when I say disaster, I mean there's a fraud that was successful. It's one of the reasons for this channel, because I want to make sure you have all the business intelligence you need to protect yourself and your organization against fraud. Chapter 11. Unusual terminology used in accounts payable. Are you fluent in accounts payable? Do you understand all the jargon that people use? In the last few years, we've added quite a few terms. Stick around for a short discussion on accounts payable jargon, and then a quick explanation of some of the terms that everyone needs to know today. Use of accounts payable jargon, or for that matter, jargon in any field, is something that we all end up doing, even though we know better. The problem is that when you do it, sometimes the people that you're talking to don't understand it, they don't know what you're talking about, They make inaccurate assumptions, or they're reluctant to ask and they assume it's something else. And this can lead to all sorts of problems. And to be honest, I'm one of the worst culprits of this. And if you've caught me doing it, despite my best intentions, please feel free to call me out in the comments section below. Often, these terms populate our conversation, and whoever we're talking to is left scratching their head because they don't know what we're talking about. And do you know when it's critical and that you really should avoid using these terms? When you're trying to get management approval for something, or you're making a proposal which will enhance accounts payable productivity, go out of your way to make sure you don't use any jargon. As an aside, don't feel bad if you don't know what certain terms mean that we're about to discuss. This happens to me all the time, and I'm forever getting on the internet checking them out. And then when I see what it is, it's like a head slapping moment, or how could I be so silly not to know that? Or sometimes I learn something new, in fact, quite frequently. So here's a hint. Don't be afraid to check out a term someone else is using on the internet when you get back to your office if you don't want to ask them. So now, let's go through a handful of terms. They're in alphabetical order, so it's not that one is more important than the other. Let's get started. Accounts payable term number 1, ACH. We talk about it all the time when we're talking about payments in the United States. Note that when it is written, it is in all capital letters. Basically, ACH stands for Automated Clearinghouse. What we mean when we say we're making an ACH payment is that we're making a direct payment from our bank account to the account of the person we're paying. It can be in the form of a credit or a debit, although most of the time it will be a credit. It's an electronic payment. Not all electronic payments are ACH, but all ACH payments are delivered electronically. It's money that goes from the payer's account to the payee's account. Now, many watching this are probably most familiar with direct deposit of payroll, which has been around for over 50 years now. Today, in addition to paying their employees using direct deposit, many organizations are paying their suppliers using ACH, and the terminology direct payment has evolved basically from direct deposit. All right, accounts payable term number 2, BYOD. We don't hear this term as much today as we did a few years ago, but it's got some implications for some of the stuff going on, so I want to talk about it. Again, note it's all in capital letters. BYOD stands for Bring Your Own Device, and it refers to the concept where people were getting tablets and mobile phones on their own at home for personal use, but they were also bringing them to work and logging into the company's ERP system, sometimes, by the way, without proper fraud protection. I want to take this opportunity, as I mentioned, to talk about a related term that many of you probably haven't heard, but is starting to permeate the business community. It's BYOAI, and it stands for Bring Your Own Artificial Intelligence. And this refers to individuals who go out and get their own AI accounts with applications like ChatGPT, Microsoft Copilot, maybe Google's Gemini, which was formerly known as Bard. I don't know why. I thought Bard was such a classy name. I don't know why they changed it. Okay, but back to the subject at hand. And so it's when you're getting something personal and using it for your work applications. Accounts payable term number 3, GPO. Most of you probably know this, but I thought it was worth including it as it is jargon of sorts. Again, note it's comprised of all capital letters, and it stands for Days Payable Outstanding. It refers basically to how long it takes to get an invoice paid. Many of you are probably already calculating it. It's something that you want to keep your eyes on if it's an issue for your organization. And if you're a public organization, you really want to keep your eyes on it because your investors will be keeping an eye on it as well. And if you're interested in learning more about DPO, we have another video on it, and I'll put a link to it in the description. Accounts payable term number 4, ERS. If you're in the automotive industry, you'll know what I'm talking about, but otherwise you may not have heard it. It's written all in capital letters, and ERS stands for Evaluated Receipt Settlement. Basically, this involves a matching and a payment process where there's no invoice involved. That's right, no invoice. The concept is pretty simple, and honestly, it makes a lot of sense. You send a purchase order to the seller gets the purchase order, they fulfill the order, and they deliver the goods. And the order, when they deliver it, includes a packing slip or a receiving document. Between the receiving document, or the packing list, whatever you're calling it, and the purchase order, which will also include terms and conditions that were pre-negotiated, you really don't need an invoice. You should be able to go ahead and pay it without having to rely on the invoice. And as I've said, to me this makes a lot of sense. Hasn't been adopted widely outside the automotive industry. There are a few places that do use it. Accounts payable term number 5, ICR. Now, most of you have probably heard of OCR, which stands for Optical Character Recognition. Again, all written in capitals. ICR is a related term, and it stands for Intelligent Character Recognition. So it's a concept related to OCR. Accounts payable term number 6, JE. Now, if you're an accounting professional, you probably recognize it. Yes, it stands for journal entry. And we've also got a longer discussion on journal entries, which again, I'll put a link in the description if you're interested in learning more about them. Okay, accounts payable term number 7, P2P. Now, we've had some competition, by the way, for this. Many times you'll see P2P in discussions of those new apps, like the new payment apps like Zelle and Venmo. In those instances, it stands for peer-to-peer or person-to-person. But when we're talking about the accounts payable and the purchasing space, and we talk about the P2P process, we mean the procure-to-pay process, which some call purchase-to-pay process. Essentially, it refers to the whole process from the creation of the purchase order to the payment. You'll see a related term on the other side called the letter O, to C, order to cash, and that just refers to the flip side of the transaction. If you're in credit or receivables, you'll know about that. All right, moving right along, accounts payable term number 8, RPA. You'll most likely hear reference to RPA, which again is written in all capital letters, in discussions about invoice or accounts payable automation solutions. It stands for Robotic Process Automation, and typically it has inherent in it some component of AI, which hopefully you know stands for Artificial Intelligence. Accounts payable term number 9, SOP. No, we're not going to call it a SOP, although I'm sure many people do. SOP is a broad term used in accounts payable and many other functions for that matter, and it stands for Standard Operating Procedure. In a well-run accounts payable function, accounts payable departments updated SOPs are part of your accounts payable policy and procedures manual. And now getting to the one that I always mess up, accounts payable term number 10, T&E. I've included this one, as I've alluded to, because it's probably my biggest faux pas and I should know better. Inevitably, if I use it when I'm giving a talk, there's always someone in the audience who either raises their hand and says, Mary, what does T&E stand for? Or if I'm doing an online presentation, they write it in the question box. So I always try and remind myself, don't forget, say T&E means travel and entertainment. And I just did it again. I'm talking about T&E and I didn't tell you that it stands for travel and entertainment until just now. You'll hear this most frequently when you're talking about expense reports, reimbursements, etc. Having a good grasp on the jargon used in accounts payable is just one part of the core competencies needed to work in, manage, or have responsibility for the accounts payable function. Chapter 12, Myths about Accounts Payable that Persist Despite Everything.
Misconception number 1. How hard can it be to work in accounts payable? You get an invoice, you pay an invoice, right? Reality. Wrong. If you take that approach, you will be paying about 25% of your invoices twice, because that's the estimate of how many invoices are currently being sent twice. And I don't think your organization can afford that. What's more, a few crafty suppliers will realize that you're paying anything that comes in over the transom, and they'll start sending more copies. What's more, with this approach, you'll also end up paying fraudulent invoices. So, no, you can't just pay whatever comes in. You need to make sure what you are paying is correct because, surprise, surprise, many invoices are wrong. Misconception number 2. The fact that my accounting system will not take duplicate invoice numbers protects us against making duplicate payments, and we don't have to do any additional checking. Reality. The fact that my accounting system will not take duplicate invoice numbers protects against duplicate payments only works in theory. It sounds like it should be the silver bullet, but sadly it's not. The reality is painfully different as processors find ways to trick the system into accepting an invoice a second time. They'll either add a dot or a dash or a space at the end of the invoice number, and then they will force it through. Okay, not necessarily a good thing when it comes to stopping duplicate payments. Additionally, this control only works if the invoice number was entered correctly the first time. As more and more invoices are processed electronically, this control should work better, but not perfectly. Misconception number 3. Our vendors return all duplicate and erroneous payments immediately. Reality. The sad reality is few vendors return any duplicate and erroneous payments. At 99% of those companies, they become the infamous credits that your accounts payable staff will so diligently work for. And when they become a credit, sometimes the supplier will send a credit memo, sometimes they won't. If they send the credit memo, maybe it will make it down to accounts payable, maybe it won't. So your best bet is to avoid making those duplicate payments in the first place, okay? Because vendors basically do not return duplicates. Misconception number 4. Since we have detailed instructions for our processes, we don't have to periodically check their work. Reality. While detailed instructions for your processes are a good starting point, that's all they are. If you don't periodically check their work, shortcuts will potentially slip in, leading to inaccuracies, duplicate payments, etc. So periodically check. Misconception number 5. Our management team would never pay for any of our staff to attend a conference, a webinar, etc. Reality. Many professionals are stunned to find out that their management staff would pay for them to get additional learning. And in fact, they see this as a positive sign that you're asking. So don't assume you're going to be turned down. Make your case for whatever educational endeavor you want to attend or participate in, be it online or live, and see what happens. All they can say is no. Misconception number 6. Electronic invoicing solutions are not for us. They are way too expensive. Reality. That used to be true, but not anymore. The price of electronic invoicing solutions has come down tremendously. Many are pay as you go, and if you haven't investigated, you may be surprised to find out just what's out there, how user friendly they are, and how affordable they are. Misconception number 7. We issue 1099s. Probably not all that we should, but this should be good enough for the IRS if we're audited, right? Reality, wrong. Not surprisingly, the IRS expects every organization to issue every 1099 it's supposed to. Its reaction will not be pleasant if they discovered you've been slipshod in your practices during an audit. There'll be fines, there'll be penalties. You could even be liable for income taxes that weren't paid. So, absolutely, your 1099 Act has to be 100% accurate. 85% doesn't work. Misconception number 8. The best practice for uncashed checks is to write them off for miscellaneous income. Hopefully, you don't think that. The reality is, it is a worse practice to write uncashed checks off against miscellaneous income. If you are subject to a state unclaimed property audit, it is the first thing the auditors will look at as part of their audits, because they know companies use this awful practice. So do not do that. Misconception number 9. Fraud is something that happens at other companies. It would never happen here. We're too big. Nobody would dare steal from us or try and steal from us. Reality. Criminals don't discriminate. Being a large company just means there are more for the crooks potentially to get their hands on. And it's up to you to make sure it doesn't happen. They will absolutely come after you regardless of size. Misconception number 10. Fraud is something that happens at other companies. It couldn't happen here. We're too small. We don't have enough money. Nobody would be interested in us. Again, reality. Criminals don't discriminate. They also know that sometimes smaller companies have weaker control, and therefore smaller companies make a prime target. Misconception number 11. We don't make electronic payments, so we don't have to worry about new frauds. Reality. The new frauds related to electronic payments have nothing to do with how you make payments and everything to do with your internal controls and how you treat your bank accounts. So don't be lulled into that old chestnut. Everyone needs to protect themselves. Misconception number 12. We use positive pay so we are completely protected against fraud. Wrong. Reality. Positive pay protects against most, but not all types of check fraud. But that is it. It does not protect you against all the other types of electronic payment fraud and all the other new innovations that criminals have come up with. So, yes, use positive pay for your checks. It is highly recommended, but realize that it is just the first step, or it should be just the first step in your organization's fraud prevention and detection program. You've got to do a lot of other things as well. Misconception number 13. Of course, management knows I'm interested in career advancement. I don't need to tell them. Reality. It is a serious mistake to assume that management knows you're interested in advancing your career. You absolutely have to tell them. Too often, management will assume that a good employee is happy in their position and they're doing a good job, so they don't consider that person for promotion. Of course, you want to be promoted. So make your wishes known, but make it known in a professional manner. The annual review is a good time to share your wishes to let everyone know that yes, I'm interested in being promoted. You can't wait until there's an opportunity and they promote someone else and then go in and say, hey, I wanted to be considered for that job, because if you do, the damage is done, so to speak. They've already given it to someone else. And even if you would have been the best candidate and they would have loved to have you, if they think you're not interested, you won't get the opportunity. So make sure in a very professional manner you let them know. Misconception number 14. Our employees have good common sense, so therefore we don't need a detailed travel and entertainment policy telling them what they should and should not do and what we'll reimburse for. Reality. Most employees do have good common sense, but unfortunately, there are a few who don't. And that's why a long, detailed travel and entertainment expense reimbursement policy to telling them exactly what you'll reimburse and what you won't is a best practice. Without that policy, you are hard put to deny a claim because it doesn't conform to what you expect. So make the policy as detailed as possible and share it with as many people as possible. Don't forget that admins typically will do expense reports for some of your executives, so you need to make sure that they have it as well so they know what they can do and what they can put in for and what they can't. Misconception number 15. A few of our managers allow their employees to take their spouses to dinner and expense it to the company. It doesn't really matter because there's only a few who do this and no one will find out. Reality. This is more of a problem than you might imagine when even one manager allows employees to take spouses to dinner and expenses. For starters, these things never stay secret. Word of it spreads like wildflower and impacts employee morale not in a good way. What's more is a few people think, well, if he can have it, why not me? And you know what? To a certain extent, they're right. But that's not the least of your problems. The IRS does not consider this a deductible expense, and it would not meet the guidelines for an accountable plan. So, a better approach would be to strictly prohibit this type of reimbursement in the company travel and entertainment policy. And remember, one of the requirements when you document a meal and entertainment expenses is that you list out who attended and what their titles were and what the relationship is to the company. Because in order to reimburse for such expenses, there needs to be a business purpose. Misconception number 16. Our VP of operations recently retired and is collecting his pension. He never really left. He continues to do the same job, only we pay him now on a 1099 instead of a W-2. The IRS really won't care because he's paying all his taxes. Reality. The IRS is the one who sets the rules as to whether someone is an employee or an independent contractor. Companies that allow executives to retire, or they outplace them, and then hire them back doing the same job, paying them on a 1099 instead of a W 2, are courting big IRS trouble. So if somebody tries to do this, point this out. Misconception number 17. When a vendor doesn't charge us sales tax, we simply add it to our payment. That way, we don't have to mess with use tax and the states will still get their money. Everybody should be happy. Reality, this is not the way it works. Vendors who don't charge sales tax typically don't do so because they also aren't required to do so. Usually that is either because the item isn't taxable, which is not a problem, or they don't have nexus in the state in question, and that is a problem. If they don't have nexus, they will not be able to collect and remit your money, and you still owe it as use tax. Should you be audited, the state will expect you to pay this tax. Whether or not you are reimbursed by the vendor is not the state's concern. What's more is, in all likelihood, the vendor took that money and then gave you a credit, and you're sitting with a credit memo on your books with that vendor, but they did not turn it over to the state as you would have liked. Misconception 18. We have an associate who processes invoices 3 times as fast as the others. She doesn't stick to our coding standard, but we figure the few errors she might introduce are more than made up for by her speed. Reality. One serious mistake will wipe out any savings you may have accrued thanks to this associate who processes faster than the others. It is imperative that everyone stick to your coding standard. This is your best way of identifying potentially duplicate payments. Misconception number 19. Paying only from an original invoice will protect us completely against making a duplicate payment. Reality. Paying only from an original invoice used to be a great way, back in the day, to protect against duplicate payments. However, technology has made this approach meaningless. Today, you can have many original looking invoices, think about PDFs, and end up paying the same invoice numerous times if you took this approach. So you need to look for other ways to guard against making duplicate payments. Misconception 20. Keeping processes in the same position over the long haul is a good idea. This way, they get to know the vendor staff intimately and can resolve discrepancies faster. Now, the reality is keeping processes in the same position over the long haul has some obvious benefits, which we've already discussed, but it has one overriding deficiency, and this kind of trumps anything else that we've talked about. And it's why we recommend, and as do most fraud experts, that processes be rotated. When an associate works on an account for a long time, they become friendly with the person handling the account for your suppliers. That's a good thing, especially if there's a problem. But it also makes collusion for fraud easier. Okay. And sometimes the two will collude to defraud one of their employers or both of them. That's why job rotation has become such a hot issue. Job rotation is something that any organization with more than one processor can do on a regular basis and is fast becoming a recommended best practice. And then, by the way, you have some backup. Don't forget that. Misconception number 21. Our employees would never steal from us. Reality, most of the time you're right. Most employees would never steal from you. Unfortunately, a few would. Identifying those few bad apples is never easy. Hence, strong internal controls, appropriate separation of duties are recommended in any accounts payable function. Too often, when there's a fraud, an internal fraud, an occupational fraud, it is committed by a long-term trusted employee, and the company is absolutely horrified when it comes to light. But what has happened is because they've trusted this employee, Joe's been with us forever, Jane's been with us forever, they never take vacation, companies will tend to allow controls to be weakened around tasks performed by these individuals, and then they take advantage of it, and the company pays the price. Not all the time, obviously, just occasionally, but when it happens, it's a real eye-opener. Misconception number 22. AI, artificial intelligence, is going to take over the accounts payable function, the entire thing, and the company won't need an accounts payable staff. Maybe that'll happen in 30 or 40 years, but for now, AI is proving to be a valuable aid or tool to anyone who works in accounts payable or accounting, but it is not taking jobs. We are decades.
In Chapter 13, New Skills and Tasks for an Effective Accounts Payable Function. What if I told you that your career success over the next few years hinges on just 5 tactics? Miss them and you might fall behind. Master them and you could lead the pack. How can you ensure that you're in the winner's circle? Well, we're going to share with you these 5 game-changing tactics with insights from really successful folks like Mark Cuban, Tim Cook, and Warren Buffett. These are tips that any professional, including you, can use to continue growing their career. Don't miss out. Your future self will thank you. Tactic number 1, stay curious, agile, and adaptable. What do I mean by this? This is going to be more important than it has ever been before. Here's what Mark Cuban, the billionaire entrepreneur, best known for being a Shark Tank regular and owner of the Dallas Mavericks, told CNBC. I can pretend, he said, that I'm going to be able to predict where AI is going and the exact impact on the job market, but I'd be lying. I have no idea. But I do know that I'm going to pay attention and be agile and be curious and be able to adapt. And by the way, for those who are listening out there and thinking, I'm too old to learn something new, let me just point out that Mr. Cuban is 66 years old. And by the way, he's not the oldest expert I'm going to quote today. If he can do it, you certainly can do it too. So what does this mean? Tactic number 2. Efficiency and cost reduction will still reign. So continue to identify efficiency and cost reduction opportunities and implement them. Tim Cook, the CEO of Apple, and a man who knows a thing or two about success, and don't forget, he worked for Steve Jobs for 13 years, and Jobs reputedly was not exactly easy to work for. But yet Jobs picked him to be his successor, and a job that he has really excelled at. He must be truly extraordinary. Anyway, he is quoted as saying, "Innovation distinguishes between a leader and a follower. Always strive to think differently and push the boundaries of what's possible." This is an approach he has used to skyrocket not only Apple but his own career. At the end of the day, just about every organization, and I'm including in that not-for-profits, colleges and universities, and others who normally don't think about the bottom line in the same way that for-profit companies do, every one organization is focused on increasing productivity and reducing cost. That is not going to change. And as you know, when finances get tight, there is a renewed focus on reducing expenses. Now, most listening to this will not come up with new products for their organization or groundbreaking product innovation, but they can come up with groundbreaking productivity enhancements for their own particular area of expertise. You know that particular area better than almost anyone. Your closeness to the day-to-day operations means you can look at the processes, analyze them, and find ways to either reduce out-of-pocket costs or improve productivity, and you can do it better than most, if not all, of the management team at your organization. So you say to me, well, how am I going to do this? We've already re-engineered our processes with an inch of their lives, and we've started using automation, etc. What's left? That brings us to the skill that no one listening learned in school, but everyone must master to thrive moving forward. And it's surprisingly easy to learn. Tactic number 3, learn how to use AI. Now, I'm not talking about becoming a coder or a programmer. I'm talking about learning how to use the tools that are on the market today and the ones that are coming in the near future. Jeff Bezos, the founder of Amazon, or as I like to say, the creator of online shopping as we know it today, is quoted as saying, "We are in the golden age of AI, and those who understand it will shape the future of every industry." Now remember, when he first had the vision for Amazon, the pundits of the time regularly predicted bankruptcy for that fledgling Seattle company. He proved them all wrong, and he is not alone. Bill Gates, the co-founder of Microsoft, is quoted as saying, "The future of computing is AI, and understanding it will be essential for anyone who wants to shape that future." Notice neither of them is talking about being a coding or a programming genius, but rather using these very valuable and often very simple tools. The success for you will come from the application of these tools. Now, remember how Mark Cuban emphasized staying curious? This is exactly what we're talking about and where curiosity pays off big time. Let me share a very simple example. When I finish recording this, I will download it and immediately run it through a piece of software that costs almost nothing. It will take out all my pauses and those moments where I needed to stop and think before continuing, etc. Whatever reason I stopped for. It will take a minute or two. That's not good news for the video editors who used to spend an hour or two getting those pauses out, but it is for me, as my video editing fees are much lower. The new must-have skill that none of us learned in school is how to create good queries for the AI tools on the market today. It's really pretty simple. I know because I've done it myself. It's mostly baptism by fire at this point. Just a little trial and error using many of the simple tools on the market today. And many of them are free. A 2024 survey conducted by Microsoft and LinkedIn found that 71% of the business leaders said they would prefer hiring a less experienced candidate with AI skills over a more experienced candidate lacking them. Now, if you don't know where to start, we've got several videos to help you, and we'll link to them in the description. But let's get started. If you find these insights valuable, by the way, I'd really appreciate it if you would hit the like button to let us know and YouTube know as well. But that's not all. It sometimes seems that we talk so much about AI, we forget the other stuff. What other stuff, you might say? That leads us to tactic number 4. Don't overlook the soft skills. They are still a very important component of any skill set. Sheryl Sandberg, former Chief Operating Officer of Meta and author of the best-selling book Lean In, says it better than anyone else. She says, leadership is not about titles, positions, or flowchart. It's about one life influencing another. Satya Nadella, CEO of Microsoft, has said, leaders are those who empower others. Soft skills are the cornerstone, if you will, of truly effective management. They bridge the gap between that technical expertise, which you probably already have, and true leadership, and of course those AI skills you're going to pick up. A good manager isn't just someone who knows what needs to be done and delegates those tasks, keeping track of the progress. Rather, a good manager is someone who inspires those around them, communicates effectively, which we all know is not that easy, and fosters a positive work environment. This doesn't come naturally to most business professionals. So how exactly do you do that? Empathy, active listening, and emotional intelligence are soft skills that are critical to help managers build trust and rapport with their team. Conflict resolution, adaptability, and the ability to motivate individuals toward shared goals ensure that a workplace will run smoothly even during challenging times. And we are heading into challenging times. By honing your soft skills, managers transform themselves from task overseers to leaders who empower teams to reach their full potential. So how are you going to do that if these skills do not come naturally to you? This leads us to tactic number 5. Embrace continued lifetime learning. And this is true whether you've only been in the workplace for 6 months or you are 6 months away from leaving, and everywhere in between. And it addresses not only those new skills like AI, but also continuing to stay current in whatever your profession is, the latest best practices, the latest trends, and also your leadership skills and your soft skills. Warren Buffett, CEO of Berkshire Hathaway, said it best when he said, the best investment you can make is in yourself. The more you learn, the more you learn. My less sophisticated version of this is, if you want to keep on earning, you need to keep on learning. And if you've attended some of my webinars, you probably heard me say that already. This is true regardless of what field you are in. And as you can probably guess from the discussion so far, it is truer today than it has ever been before in the past. Luckily, there are numerous resources available to help business professionals just like yourself do that. We've talked about a lot of things, but what we haven't addressed is the proverbial elephant in the room, automation and technology, and the inroads it is making into the accounts payable function. But we've got you covered on that front. We put together an information-packed session about specifically automation in accounts payable. You can watch it right now using the link that has appeared on your YouTube screen and is in the description. Good luck.